It's about educating you on all of the options that are out there when it comes to selling your assets, your highly appreciated assets. And capital gains is a huge, huge concern for real estate investors, for business owners, for pretty much anyone that's put money into something over time and boom, now they made a lot of money. Uncle Sam's coming for their cut, right? So it's so important to be efficient and really know your options. Besides the 1031 exchanges and the installment sales and all those things are great. Those are great strategies, but they're limited. And we're going to really be opening your eyes to some of the possibilities and different things that are out there. At the end of the day, everybody that's an investor, if you make money, part of your profits are going to go to Uncle Sam. You're in a silent partnership with the government, with the IRS. And unless you're being efficient, unless you're being proactive, Uncle Sam can take a lot more of that pie than you want. And so that's really going to be the focus of this is not just, okay, how to do good, but how do we get better? How do we be more tax efficient when it comes to legally keeping our money? There's a big difference between tax avoidance and tax evasion. We'll be going over that in a little bit. A few different disclosures to go over. Obviously, in our strategy classes, this is pure educational information. This is not financial, legal, accounting, or tax advice. We do have a back office, and we do give advice for our clients, but no one in here in this room that I can see yet is a client. We do have clients that come on these calls as well. But this is purely educational information. Obviously, when it comes to implementing any type of structure or strategy, you want to do that with a licensed tax professional or your tax professional, preferably. So questions, how we're going to do questions is we want to make sure that this is a real, learning session. This is not, hey, I'm going to be throwing a whole bunch of slides and, boring you with information. This is interactive. So we want you to ask questions. And I'm the type of person that if I don't get it off my mind right away, I will forget. So if you have a question, type it in the chat. And trust me, I'm going to get to your questions at the end. Even through a lot of the slides, I'll probably get to a lot of your questions. But type those in while they're fresh on your mind before you forget, because a lot of times people wait to the end and they're like, "Oh, I forgot my question." So type it in. Make sure that these questions are relevant to this training. Obviously, we're going to be talking about capital gains taxes. Specifically, I know a lot of you, may have questions. Oh, I have an LLC, I have an S corp. I heard about putting money in a 401k or IRA, Roth, life insurance, all these different things. We have classes for those. We have a lot of educational material on our YouTube channel, the Tax and Estate Academy. But this is going to be specifically about capital gains. So everyone that registered for this, again, you're either considering or in the process of selling a highly appreciated asset in the next, year or so, and you're looking for strategies and structures and things to be more efficient. That's what this class is. And at the end, we will have an open mic session. So you will be able to have the opportunity to unmute yourself, talk and ask your questions, because sometimes things get lost in translation when you're typing something in the chat and it may not be what you're actually trying to ask or whatnot. So now, real quick, for those of you guys that don't know who we are, we're Prudent Wealth Strategies. My name is Stefan Belholm. This is Michelle, my partner in crime and
Hello,
partner in
hello.
life. She's my wife. We are certified tax strategists, estate strategist specialists. I'm a registered tax planner as well, enrolled agent with the IRS. And basically, what we do is we help high-income business owners, investors, and professionals utilize advanced tax structures and estate planning structures and strategies so that they can, number one, reduce taxes legally, right? Protect their assets. We're going to be talking a lot about asset protection, which is super important. A lot of people, they focus a lot on the tax side. Oh, let me do a cost segregation. Let me depreciate. Let me go buy this equipment. But then they have a whole bunch of assets that are not protected. And when a lawsuit comes, when creditors come, when some liability happens, they're just completely exposed. So we're going to be talking a lot about asset protection, but most importantly, at the end of the day, this is about leaving a legacy efficiently. And the key word here is efficient, right? Because all of you guys, you've done, what you've done up until this point, and it's safe to assume that you've done pretty well. But how can we make you better? How can you be a little bit more efficient than what you're currently doing? And that's really what we focus on. We are in the Holly Springs area, Raleigh-Durham area of North Carolina. For those of you guys that aren't familiar with that area, we're right outside of Raleigh in the metro Raleigh area. Been in the financial services industry since 2006, basically 20 years. We'll talk about more of my story at another time. This is not about me, it's about you guys. But we're experienced business owners and investors. We have lots of different investments. I've owned businesses, still own businesses besides Prudent Wealth Strategies. We run a tax firm, an insurance agency. And we've been through a lot of what you guys are doing. We've been through the exit, sold houses, exited businesses, made some money, lost some money, right? We've been through the trials and tribulations of being an entrepreneur. And when you work so hard to build what you have, you really want to, be as efficient as possible with it. And that's really what we're all about, educating people. And a lot of this stuff is we've made these mistakes ourselves, so we know what not to do. And our average client has a net worth of anywhere from $5 million to $15 million. We don't say that to brag. We have a lot of clients that make a lot more. We're actually working with one that right now that's going to be exiting their business hopefully in the next year, looking at close to about maybe 500, $600 million. But our sweet spot, most of the clients that we work with are average, business owners, investors that do really well for themselves, but they get killed with taxes. And they don't understand that there's strategies and structures that they can implement right now. And you don't have to be a gazillionaire. You don't have to be a billionaire. And we'll go over that. So that's a little bit about who we are, but most importantly is our team. So we have a whole team of tax attorneys, estate planning attorneys, fiduciaries, forensic CPAs, enrolled agents, strategists that they focus on doing what they do and they're really good at. Wear one hat and they wear it really well. And that is why we love the partnership that we have with all of our team members and people that we work with, because these are people that are experienced. They've been doing it for many, many years. They're in the trenches. They're dealing with clients like yours. And that's why they're so successful, and they know when to pass a torch. So that's really, really what makes us who we are. It is not just us; it's who we work with and their experience. And if you decide to work with us, working with us, you can keep your trusted advisors, your CPA, your lawyer, your attorney. We don't want you to change anything. Okay. Matter of fact, we have a lot of strategic partnerships with tax firms, with law firms, with financial advisors, because a lot of them do not have the tools and resources, or at least access to a lot of the tools and resources that we have. And so we can help a lot of their clients as well. So if you're, a real estate broker, business broker, financial advisor, CPA, and you're looking for a strategic partner to help some of your clients with advanced, tax strategies, they have problems selling their business, looking at capital gains, different things. Even, they have a huge IRA, 401k, they're trying to exit it, not get killed with taxes. We have a lot of different strategies. So we can, have those partnerships. And the whole goal is to become part of your team, because whoever you're working with, I'm sure they're doing a really good job with managing your money or filing your taxes and making sure all the paperwork is done and all the forms are filed at the right time. But there are some things that are missing, and it's causing you to lose a lot of wealth, to leak a lot of money out of your financial picture. And so that's where we want to kind of come in, and our goal is to help you to become more efficient with how you grow and protect your wealth. Okay. And that is pretty much it. So we're going to get along with the class. So the agenda here, again, this is the capital gains strategy class. We're going to be, again, exclusively focusing on capital gains strategies and how to utilize these things to mitigate capital gains when you exit, whether it's a business, it's a real estate investment, it's anything that you've held for a long time and you're looking at a huge gain. So that's what we're going to be talking about. So number one, we're going to talk about some financial and tax concepts that you're probably not aware of. Again, most of you guys are familiar with the 1031 exchanges and the installment sales and all these different things. And again, they're great, but there's a lot of limitations, and it's just so important for you to be aware of your options. We're going to go over some unique ways to not only defer taxes, okay, because deferral is great, but what if we can reduce that tax, actually reduce your tax bill, drop it down, not just kick the can down the road, or eliminate some of the capital gains when you sell or exit your investment. So that's really what we're going to be focusing on. And we're going to be talking about how today's billionaires have $1 work for them in two or three places or more at the same time. This is leverage. And this is a big thing that a lot of people in real estate, in business, that they've probably heard of, but they just don't know how to implement and to do it. And so we're going to be talking a lot about leverage as well, because that's a huge thing if you're, selling or and exiting any assets. And then we're going to talk about how to put a game plan unique to your situation because everyone's situation is different. And then at the end, again, we're going to have that open mic Q&A. So, real quick question for everyone in the chat. Where do you think tax rates are going right now? As of today, where do you think tax rates are going? In the chat, just type a one if you think that tax rates are going up. Put a one in the chat if you think tax rates are going up. If you think tax rates are going to be the same, put a two in there. Put a two in the chat. I want to see what you guys think. Where do you think tax rates are going? Let's see some ones. See a lot of ones, a lot of ones. There's one, two. Okay, a lot of ones. Okay. So a lot of you think that tax rates are probably going up. Well, here's where we're at, and here's where we've been. The highest tax bracket in U.S. history is 94%. Most people don't realize that. Like, what? Was that high? Yes. This was back in, the late 40s, mid 40s. I don't know anyone that's on the call that was alive back then or earned that kind of money back then, but that was the highest tax bracket in the 1940s, 94%, which means after you made, I think it was $200,000, which $200,000 back then was equivalent to about, $3 million. Every single dollar got taxed 94%. Okay. The next highest, second highest marginal tax bracket in U.S. history in the 70s was 70%. A lot of you guys might be familiar with Ronald Reagan, right? Before Ronald Reagan was a president, what was he? He was an actor, right? And he made money acting. But one of the things, and you can go and Google search this, he's like, yeah, I only did one or two movies a year because if he worked any more, he'd be paying 70 cents on the dollar for every single dollar that he made. And the rest of it that he had left would probably be going to the state of California because that's where he lived. So tax rates have been that high, but right now the highest tax bracket today is 37%. So relatively speaking, if we look at the history of taxes, we are in a relatively low tax environment, right? I'd much rather pay taxes at 37% than 94 or 70%. But the reality is that's where we've been history-wise. But we also have to look at what we have going on. And right now we have about what, 38, last time I checked, which was like 2 days ago, $38 trillion in debt, right? Not only debt, but unfunded obligations and liabilities, right? Medicare, Medicaid, Social Security, pensions. I don't know how many of you guys have pensions, but pensions are basically insured by the government. That's a guarantee that the government has to provide. Healthcare, the CARES Act, so the whole COVID thing, billions of dollars in bailouts, defense, war, welfare. So it's just going to continue to go on, right? There's a massive amount of debt that we have. And we talk about capital gains, and this is a big thing that people don't realize. Capital gains rates, capital gains is coming up more and more. This is an article from back in 2021, 2022. There was more capital gains triggered in that year alone than any year prior, in the 2 or 3 years prior. $500 billion in capital gains. Capital gains may have triggered hundreds of billions more in individual tax for 2021. Why is that? What happened in 2021, 2022? Anybody think or guess what happened? Type it in the chat. What do you think happened in 2021 when it comes to real estate? Yep, right. Home prices went up significantly, right? And people were selling because it was at the height of the market. And what happened? A lot of them got killed with capital gains taxes. We have a huge, great wealth transfer. This is the greatest wealth transfer that's happening in the next 20, 25 years. You're talking about $120 trillion of wealth that's going to be passed on from the baby boomer generation. I don't know how many boomers are on the call. If you are, that's okay. We work with a lot of boomers, but to their heirs, their kids, their grandkids, all this wealth is being transferred. It's the largest wealth transfer in the history of this country. On top of that, we have low birth rates. I don't know about you guys. How many people on the call? How many? Just type in the chat if you had more than three siblings. Type a one in the chat if you have more than three siblings, or type in the amount of siblings that you have. I know my mom had 11. I had 11 siblings. Wait. yeah, 11 siblings. My mom, no, 10, because there's 11 of them total. So 11, right? Um, we're having less and less kids is the reality here. Okay. And when you have a population where there's less people, what does that mean? That means that the government has to find some way to tax differently because if you have less people, there's less tax revenue. On top of that, and this is the biggest thing we have to understand, is that tax laws change over time, right? The government changes what the tax rates are. It's happened this past, year. The One Big Beautiful Bill Act, there was a lot of tax changes. Even before that, in 2016, there was a Tax Cuts and Jobs Act. There's always going to be tax changes. So the government always changes not only the tax rates, but the brackets. They can change where your level of tax is. They can create new provisions. They can create new taxes. This is what happened with the net investment income tax, the Obamacare tax. They could take away deductions. They can take away credits. And these are the things that cause you to pay more taxes. These are subtle things that people don't realize that cause them to pay more taxes. So ask yourself again, if we're looking at government debt, we're looking at a whole bunch of unfunded obligations and liabilities, we're looking at a huge amount of wealth transfers, low birth rates, tax law changes. Do you care if tax rates go up? Type a one in the chat if you care that if tax rates go up. Just type a one. See a few ones, two, three, five. A lot of you guys are typing one. Okay. A lot of you guys care if tax rates go up, and rightfully so, because again, you've built up a lot of wealth over the years. But here's the reality. Wealthy people don't care if tax rates go up. It's just that simple. And it took me a long time to realize that because I'm like, oh, well, the people that make all this money pay a lot of taxes. Not the smart ones. They don't care if the tax rates go up. Why? Because they have strategies and structures and a lot of the stuff that we're going to be talking about set up. And these are the things that you need to set up right now. But again, you don't have to be a gazillionaire to utilize a lot of these strategies. One of the things we're going to talk about is the five pillars. You guys should have received a workbook in your email that goes over a lot of the stuff that we're going to be talking about in the slides. If you did not, just type your email in the chat. We'll make sure that gets out to you. A lot of times it went to spam or whatnot. So just type your email in the chat and we'll make sure that you get the workbook because it goes over a lot of the stuff that we're talking about in detail. But we're going to go over the five pillars. This is super, super important to remember. These are writer downers, but liquidity, leverage, structure, strategy, and timing. We call it our list, our little list. All right. Liquidity, leverage, structure, strategy, and timing. You have to have these five things set up and set up the right way if you want to be tax efficient when you exit your businesses, investments, whatever it is. Okay. We'll get back to that and we'll go over more of that in detail. So let's talk about how capital gains taxes work. For those of you guys that don't know, obviously, that you're going to pay a tax when you sell your asset because you made a profit. But how does it actually work? Well, if it's a capital asset, which is pretty much anything that you can think of, stocks, property, business, if you bought it and you're selling it for more than what you bought it, it is obviously considered a capital gain, but it is going to get taxed differently depending on when you're selling it and the time period. So long-term capital gains, and that's the focus of what we're going to be talking about in this strategy class is long-term capital gains. So again, buy and holds, property, business, all these different things. Right now, it is 20%. We'll talk about kind of how that rate actually shakes out because it's not actually 20%. In many cases, it's a lot more. But it's 20% your tax on that gain if it's held over more than a year. If it's short term, meaning you bought and sold it in less than a year, and we'll talk about that as well because we have a lot of clients that they're real estate flippers or they're wholesalers. They buy and sell investments, they day trade, they maybe even flip businesses. We have some clients that do that. That short term, if you're doing it in a few months, that's going to be taxed at ordinary income rates, which are much higher. So that is the basis of kind of how capital gains taxes work, but it's a lot more complex than that. I'm not going to get into the intricacies of how it works. Again, that's going to be in your guidebook, but this kind of gives you a basic understanding of how that works. So the big thing to really understand when it comes to capital gains is number one, that capital gains, it stacks on top of your other income. So if you have income from a business or a W-2 salary or retirement, 401ks, IRAs, one of the big things that we deal with is people that are in their retirement ages, they're, 70, 71, they have these RMDs coming out of their retirement accounts and they're selling their real estate portfolios. It really kills them, right? Because they have other income. So your capital gains, that 20%, it's up to 20%, is based off of the other income. So controlling and being able to control your other income directly impacts how much of your capital gains are taxed. And that right alone, for a lot of people, we can do a few different quick moves here and there to mitigate your taxes because, hey, we can take some of this money that you're earning from your business or your rental properties or whatever. And if we can drop that down, now your capital gains is much lower. We have a lot of clients that they're making, five, $600,000 a year and paying zero capital gains taxes just from that. So that's very important to kind of understand. But the other thing is the key to reducing your taxes is having control. Okay, we'll go over income and all that stuff, but tax control, having control is so important. That's what wealthy people understand. But what the government considers income. Okay. So not all of the sources of where you get money, where you have cash flow is considered income for tax purposes. Like if you have money in a Roth IRA, right? That's not taxed. A lot of people don't have those types of structures set up. And we'll talk about how that works. But the key really here is having control over what the government considers income. Because if the government doesn't consider income, you're not paying taxes. Who here doesn't want to pay tax legally? Type a one in the chat if you don't want to pay taxes legally. Otherwise, you shouldn't be in this class because that's pretty much all we're going to talk about. See a lot of ones in the chat. All right. So how does calculation work when it comes to capital gains? And again, I'm not going to go too much into the intricacies, but just wanted to kind of paint a broad stroke of what we need to look at to calculate, okay, number one, does it strategy or structure make sense? Because for a lot of people, it doesn't make sense. I'll be very, very upfront and honest with you. We have a lot of people, we do a lot of capital gains strategy audits. By the way, if you haven't scheduled an audit, if you need to schedule a capital gains strategy audit, we have a few of those opened up. We'll talk more about that at the end. So if you want to talk about your situation a little bit more in detail, really figure out what's going to work, we have some of those time slots for early next week. Later next week, we're super busy. So that being said, so what are we looking at? Number one, we're looking at your basis, your purchase price. What did you buy that asset for? Whether it's a stock, real estate business, what did you actually put in to start that asset? Then we're looking at your improvements, what you put in, right? This is really going to apply to real estate more, a little bit for businesses, not so much stocks and stuff like that. But, hey, we put a new roof, we added a driveway, whatever. Those improvements, that is going to add to your basis. Okay, so what you bought the property for, your principal, cash, whatever, and then what you improved. But then we have to look at depreciation. And this is a big, 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 big deal for people in real estate because a lot of people in real estate, they love the paper losses of depreciation. They love bonus depreciation. They love the cost segregation, right? And we'll get into that in detail. But the reality is it's an IRS partnership. Okay. If you take depreciation, you've essentially gotten to a marriage with the IRS. And just like any marriage, once you decide to split up, they get to take half. Like Eddie Murphy said, give me half, Eddie, right? That's how it works. And so that depreciation gets added to your adjusted basis. And this is your tax baseline. So your adjusted basis is your tax baseline. This is the baseline of where we figure out how much capital gains that you're looking at. that you're actually going to pay taxes on. A lot of people don't realize that. They think, oh, I just took some depreciation. That's nothing. I wrote it off. No, it's going to come back. And we'll get into actually how that works. But again, the reality of depreciation is, in the South, they have an old saying, for every gimme, there's a gotcha. Okay. And with depreciation, the gimme is the years that you have that property, you use depreciation, it reduces your taxable income, right? You pay less taxes when you have that property. But when you sell that property, that's the gotcha. That's where the depreciation recapture comes back, and it comes back to bite you in the butt very severely. Now, the way that capital gains taxes actually work, when it all shakes out, is they're going to look at all of your income, again, all your other income from retirement, 401ks, IRAs, W-2, rental properties, all that stuff. Then they're going to say, okay, how much of a capital gain did you have for that year? And then there's all of these other taxes. And these are things that people don't realize and don't understand. You got a net investment income tax. If you have a certain, if you pass a certain income threshold, that's an extra almost 4%. This was used to fund Obamacare. Depreciation recapture. We just talked about that. If you take depreciation, guess what? The government's going to come back and recapture 25% of that depreciation and add it to your tax bill. State tax. If you live in a state that has state tax, like here in North Carolina, we have about 4 or 5% state tax. That's going to add it. Mortgage over basis, debt over basis. This is a big thing that people in real estate don't understand. And a lot of CPAs don't understand. Matter of fact, I do CEs for CPAs. And basically, if you have a debt, let's say you refinance a property and you have a debt over and above your basis, your adjusted basis, when you sell that property, right, you got to pay the mortgage back, obviously, but that difference is taxed, which is crazy because loans aren't taxed by tax law, right? And we'll talk about that more when it comes to leverage. But in this case, in real estate transactions with the tax code, if you have that, then that's going to be taxed 40%, basically. A lot of places have a mansion tax or a transfer tax, depending on what jurisdiction you are in the country. I have a lot of clients selling property in California or New York and stuff like that. And so there's a whole bunch of taxes that you actually have to pay. And a lot of people don't realize it until they're at the closing table or right before closing. And for a lot of them, it's like, holy crap, I'm gonna pay this much tax. I'm not gonna sell. And they back out of the deal, or they say, hey, we're gonna do a 1031 or do this, all these different things, which are not really efficient. You're just exacerbating the tax problem. You're not really solving anything. So at the end of the day, it's not what you make, it's what you get to keep, right? And you can only keep more if you're being efficient when it comes to planning. And that's why being proactive, setting all these things up now is so important. I'm going to stop real quick and just answer some questions. Is there any questions that we have in the chat? Shelly? No?
So we just have a request for the workbook,
Okay.
and
Perfect.
I said
Perfect.
we'd send one out.
Yep. Yep. Everyone will get that. If you didn't already get that, we'll make sure it gets resent out.
Just want to reiterate, if you have a question, please type it in the chat at the end. We'll mute you all, and
Yeah.
we'll address individual.
Yeah, type your questions right now because if you forget it, then and that happens to me. I'm 41 years old, so it can happen to anybody. So type it in while it's fresh on your mind, and I will definitely get to it. But at the end, we'll do the open mic, and you can ask as well. So at the end of the day, this is about using the tax code to your advantage, right? That's what we're talking about, using the tax code to your advantage. And a lot of people, when they hear about stuff or that, their immediate thing is, oh, it's going to cause an audit. This is not kosher. Oh, this is gray area. No, everything we're talking about is black letter law. It's in the tax code. It's just how you use it. And the funny thing is, there's lots of people, many of these people that have worked for the government for, decades, almost 100 years, buildings learned in hand, basically said anyone may arrange his fares so that his what does it say? His taxes shall be as low as possible. He is not bound to choose a pattern that best pays the treasury. There is not even a patriotic duty to increase one's taxes. Over and over again, the courts have said that there's nothing sinister in so arranging fares as to, oops, as to Keep taxes as low as possible. Everyone does it, rich and poor alike, and all do it, for no one owes any public duty to pay more than the law demands. This is coming from a guy who worked for the government. He's a judge for the U.S. government. Same thing with this guy, George Sutherland, the legal right of a taxpayer to decrease the amount of whatever otherwise would be his taxes or altogether avoid them by means which the law permits. And that's the key word, right? Using the law, right? Cannot be doubted. And they actually used this in a case probably I want to say 6, 7 years ago. They restated this, and the person won the case. And Billings learned in hand again. He said, in America, there are two tax systems, one for the informed and one for the uninformed, and both are legal. And this couldn't be a truer statement because the reality is a lot of people are just not informed. And the IRS, the government's not going to sit out, pass out advertisements and billboards about, hey, this is how you can pay us less. No, it's there in the tax code. It was written by attorneys. It was written by congressmen, right? Who put this stuff together, right, for themselves and for their constituents. And it's up to you to understand how to utilize it. But if you don't know, you're just going to pay more. And that's what happens. That's
The
what happens.
government wins when you know less. So our job is to inform you and help you to know more so you can keep more.
100% legally. And this is the biggest thing too. Lucy Parsons says, never be deceived that the rich will permit you to vote away their wealth. Because all the time I hear, oh, what happens if this goes away, that goes away? I'm like, you have to understand. This is a system here. Okay. This stuff has been happening for a very longer than me. It'll happen after I'm gone. Wealthy people, the system is rigged. So you either get on the side, what's the old saying? You either beat them or join them, right? So we're on the team, we're on the side of joining them. And again, it's just understanding how to use the tax code to your advantage. Big difference again between tax avoidance and tax evasion. Tax avoidance, a lot of people, very smart people, I talk to engineers all the time, don't understand. This is an actual word that the IRS uses, avoidance. Compliance gets mad at me sometimes because I use the word avoidance, but I just say, hey, this is what the IRS uses in their literature. Tax avoidance is legal. Using proper deductions, claiming credits, adjustments to income, exclusions, allowances, exemptions, right? We'll talk about those. Those are the three things we'd like to use, not just deductions and deferral. That's legal. But hiding assets, not giving information, omitting information, falsifying information, taking improper deductions, that's tax evasion. That'll get you jail time. That'll get you the Wesley Snipes time. We don't want that, right? And so there's a fine line between that, and you have to understand it. Again, look at the IRS literature. It says right here. You can Google this, Chat GPT, Gemini it. I don't care. Tax avoidance is perfectly legal. This yellow book right here, this is the IRS handbook for special agents. It says right here. So when those IRS auditors come and knock on your door, this is the book that they get instructed for by. And it says tax avoidance is not a criminal offense. Any attempt to reduce, avoid, minimize, or alleviate taxes by, again, a legitimate means is permissible. So tax avoidance, it's written black and white, it's legal. A lot of people, you'd be surprised every single week I have this conversation. Oh, you can't. No, you can. It's just how you do it. And it's not just the deductions and the buying the trucks and putting money in a retirement account. Those are great strategies, but there are more advanced things that you need to be aware of to mitigate taxes. And we're going to be going over that today. So obviously, a lot of the celebrities, a lot of the wealthy people, utilize these structures, right? You have Jeff Bezos, his ex-wife Mackenzie Bezos. He donated a $55 million estate. You think she did that for no reason? Hell no. She's not an idiot. Bill Gates. If you heard anything about Bill Gates, his wife, what did he do? He donated, I think it was like an $8 billion to her foundation. Why did he do that? Tax purposes. A lot of people talk about the Kennedy curse, but not a lot of people talk about the Kennedy purse. And the Kennedys are still to this day one of the wealthiest families because of these structures. Trust. We're going to be talking a lot about trust, specifically dynasty trust, when we go into strategies. But as you can see from this article, handled correctly, a dynasty trust could potentially maintain an untaxable fortune indefinitely. Indefinitely. You know what that means? Very long time. Very long time. Okay. Um, Patagonia. Okay. Those nice, comfy, very expensive sweaters and outdoor gear. The guy that owned it, he transferred his stock to a purpose trust, Patagonia Purpose Trust. Again, Google this. $3 billion of his stock transferred to the trust. Why? So that he and his family could avoid taxes legally to the tune of $1.6 billion. His family's and he and his family is avoiding legally. AT&T, they did a deal with Warner Media, $43 billion transaction. So you can see right here, no tax on the gains from the deal. They used a structure called the reverse Morris Trust. Okay. And it got a favorable IRS ruling. So this stuff isn't like in some secret cave or cabal that like this is public information. This again, most people don't understand how these things work, and they think that this is only for the ultra wealthy. Okay. I was talking to a guy the other day. I think his net worth is maybe 25 million. And he's like, no, I can't utilize this. This is only, I'm like, dude, this is right up your alley. This is exactly these types of structures were designed for you, but you think you're too right here. Like you need to be doing exactly what these guys are doing. Otherwise, you're just going to continue to pay taxes. So you don't need to be a gazillionaire to use the tax code to your advantage. You just need to understand what exists and what's out there. So let's talk about some capital gains pitfalls before we start getting into a lot of this stuff. I know a lot of this stuff feels overwhelming and it's a lot, but these everything that I go over in this training and this strategy class is for a reason. It's to build on certain principles and concepts so that everything these strategies make sense. Because otherwise, it's just okay. Go read a strategy. Go Google something go you don't need information. You can find the information all day, but if you don't understand the nuances and the this old saying, the devil's in the details, right? Then it's all for naught. And we've met people all the time that they spent lots of money with attorneys, they've done this and done that, and they actually ended up screwing themselves because they didn't understand. They didn't understand. And the CPAs, the attorneys, the advisors, they're happy to make money, make commission, take your money. They're not necessarily there to educate you. Okay. So
That's
it's
right.
so important to understand all of these pitfalls and everything that we go over in this class. So let's talk about some very common capital gain pitfalls. Number one is primary residence. Okay. And I see this all the time. I get DMs about this. I get emails, all this stuff, but primary residences. For most people, I would say for probably maybe 80% of the people out there, primary residence, super simple, super easy, right? Because of the first point here, which is Internal Revenue Code Section 121. This is where you're able to sell your primary residence if it's appreciated, okay? You bought it for this, now it's worth this. If it's appreciated, right? You can exclude 250,000 if you're unmarried or $500,000 if you're married worth of capital gains. Okay? So you bought your house, was $200,000, now it's worth $700,000. If you're married, guess what? No capital gains taxes. Simple. Or so you think. Number one, it has to be owned. There's an own and use provision. So it has to be not only owned by you, but you had to have used it as your primary residence for at least 2 of the last 5 years. And the IRS does check for this. And there's lots of different things and parameters they look to verify that that was your actual primary residence. And a lot of people in real estate and all that stuff, they come, they say, oh, we've been using this strategy. We got dinged. Why? Yes, this is why. So a lot of nuances. But number one, it's only for your primary residence, and you have to live there and own it for at least 2 of the last 5 years. It does not work on investment property. It does not work on a rental property. Does not work on your second home or commercial property. Only primary residence. A lot of people, they go on TikTok, they go on Instagram, they go on YouTube, they hear this stuff. Oh, I can buy real estate and sell it and pay no capital gains. So it's $500,000 if I'm married. No, there's lots of nuances. You have to understand that. The other thing is You know, a lot of people, they have a rental and then they convert it to a primary residence. A lot of people do that. Anyone did that before? Type of one in the chat if you did that. You had a rental, fixed it up, depreciated it, got some rental income. Then you're like, oh, I want to live here now. You have a lot of people, they do that. Guess what? Probably won't be able to get that exclusion when you sell, right? There's depreciation recapture. There's a lot of nuances. Everyone's situation is different. This gets really tricky with job changes. I'm in the Raleigh-Durham area. We have a lot of people that work in tech that, they work for, a pharmaceutical company. They get moved around a lot. So it can get really tricky with job changes, health, death. You have a death with a spouse. You have a spouse dies. There's a certain time frame where you have to capture that 500,000. After that, you might not. If you get divorced, there's issues there. So lots of different nuances. This is something that can happen. Again, with a lot of our clients, it doesn't matter whether it's a primary residence or an investment property or anything, we can help them with capital gains, especially if you're looking at a primary residence that is a very, very high value property. So high end real estate, luxury homes, stuff like that. This really is a big deal because that $500,000 ain't nothing, right? We got clients in California, their house is 5, 6, 7 million dollars. They're looking at huge capital gains, and we'll go into an illustration in a little bit. So it does help, but you have to understand how this works and how to utilize it and how to, hey, even if I do get the 500,000 or 250 exclusion, if I have a capital gain over that, how can I mitigate that? And there are structures and strategies that you can implement where you can not have to worry about capital gain, even if it's over the exclusion. The biggest thing with this though is a lot of people they say, "Hey, I'm just going to put chandeliers and all this stuff into my property because I can get a gain." That's fine. Big thing with this is that a lot of people will push a lot of their wealth into real estate, which is fine. I don't care what you invest in, but real estate, and the reality is it's very illiquid. So if you're doing it just to chase a tax benefit, not such a smart thing to do. There are more efficient ways for you to leverage. You can still put the shiny stuff in your house, but there's more efficient ways to do it from a tax standpoint. Leaving assets to heirs, pitfall number two. It's a big, big, big thing. You see it all day, every day. The stories that I hear on a weekly basis, you'd be shocked. But the whole point is if you're leaving any assets to heirs, if it's a capital asset, so stocks, business, real estate, the things that typically have to deal with capital gains taxes, your heirs get a stepped up basis. And that stepped up basis is to the fair market value of the asset at the time of the owner's death. So what does that mean? So the example here is generation one. So let's say dad bought property, was $100,000. By the time he died, it's $1 million, right? That's the fair market value at death. So the generation two, the next heir, their basis becomes $1 million. So they can sell that property for $1 million and not pay capital gains tax. That's a good deal, right? Because when dad was alive, if dad would have sold that property, he would have had a $900,000 capital gain. So stepped up in basis is good, but again, a lot of nuances. Number one, the basis is determined at the time of death, not the time of the sale. Okay. And so this is a very, very, very tricky thing to understand because a lot of time when kids inherit property, it may take some time to work out the kinks. Who's going to get this? Who's going to get that? Junior gets this property. Sally gets that property, right? And they may not sell that property for another 2 years, 3 years. Who knows? Sometimes it might be sold quickly, right? We've had that a lot of times. If it's sold quickly, then not a big deal. But if it's anything after the time of death, so let's say you inherited the property in 2024, right? It was $1 million, your basis. Now it's worth $2 million in 2026. You have to pay the capital gain now on the $1 million, on the difference between your stepped up basis and the new fair market value. A lot of people don't understand that. They think, hey, I inherited, I can sell it for whatever, whenever I want and not pay capital gains tax. It's not true. It's based off at the time of the owner's death. Okay. Um,
Yeah, there's a pitfall with this strategy on in the fact that sometimes the estate gets caught up in probate. So, and there's arguments amongst the siblings. One sibling wants to sell, the other sibling has an emotional attachment. So sometimes that prolongs the sale as well. Not only can the capital gain be increased, the value of the property increase, there's also been times in our career that we've seen where it decreased. Think back to 2008, 2009.
Hmm.
At the time of death, mom, dad passed away, the property was worth this much. A week later, it
Yep.
wasn't, you know,
Yep.
and they're still on the line for what the fair market value was at the time of death.
Yeah.
So
There's
that's something to consider.
a huge thing, and there's no deduction for that. So you get a step
Yeah.
up basis, step down, ain't working the same way. So yeah, that's why trust planning, proper trust planning and funding is super, super important. A lot of people, they'll get a trust, they won't fund it. They'll say, "I put 123 Main Street in the trust." No, you got to go down to the county, file the deed, do everything the right way, and make sure that your trust is updated. A lot of people don't do that to avoid probate, because probate is a B. And that's a huge thing with leaving assets to heirs, is that delayed liquidity. Again, we talked about the five pillars, right? And now there's not a lot of liquidity, there's not a lot of money. And what happens a lot of times with probate is what? Fire sales, discounts, right? We sell it for way less than we could get because there was no proper planning. Another thing to understand is your retirement accounts, 401ks,
Stefan, I
IRAs.
just want to say one more quick thing
Yeah.
about that. Don't rely on your trusted financial advisor to think that they have that structure set up and funded properly. We have so many clients come to us after they had spent tens of thousands of dollars with their trusted advisor that did not set up, fund, and execute their structure properly. And at that point, there's nothing that we can really do to help them with that loss. So you want things set up proactively. There are some things if you already have a capital gain that we can do retroactively, but as far as like that trust and everything to avoid probate, it's really sad. We've had quite a few emotional clients come to us and it was out of our hands. We couldn't do it because their trusted advisor, their brother-in-law, their family lawyer, they didn't do it right.
Hmm. No one's gonna care more about your stuff than you, and that's a big thing that we preach
Yeah.
to our clients. Like, you really, really have to be dedicated. Doesn't matter, and the higher your net worth is, the more you have to be concerned, because a lot of people think, "Oh, I make this much amount of money. My advisor's good. I work with the best of the best." No, they're just normal people like you and me.
Yeah.
They make mistakes, and it happens. So yeah, you have to understand how
You
to
you want
be
to you
proactive.
want to follow up with that. You want to make sure your structure is funded. You want to make sure that everything is titled to it properly. You want to make sure with great life events, you had an extra child, you added them in there as an heir, you had a divorce, you update your policies and everything that every year you should do a little review.
100%. We have processes and procedures within our firm to help with that. We actually do quarterly reviews with our clients and stuff like that. So lots of different things to kind of understand. But there's no step up in basis for retirement accounts. It's a big thing people don't understand. If you're leaving behind 401ks, IRAs, SEPs, simples, guess what? Your kids get no step up in basis, and they got to pay the tax within 10 years. Okay. Lots of different things. We're not going to talk a lot about retirement accounts. We have a whole other strategy class on that, but that's a huge thing. Um, Joint ownership. Okay, this is a big thing. Joint ownership with non-spouses, mainly kids. Sometimes grandkids. We have a lot of people that have own properties and stuff with grandkids. But this really kills stepped up in basis. I'm gonna get to that next. But when you joint own something with someone, it's considered a gift if they're non-spouse. And that is really what's going to kill that step up in basis. And I'll go over an example exactly. But joint ownership, a lot of people do it because they think it's easier to kind of have their kid manage stuff and handle stuff and pass things on if something happens. But it's really not an efficient way to do things. Um, and leaving assets to heirs, the big thing with the step up in basis is it doesn't work if the person who died received the asset from you within 1 year before death. What does that mean? It's a clawback. This is the thing. I'm gonna paint a scenario. I got a property worth $2 million. I got a $2 million capital gain. What we're going to do is we're going to give it to grandma because grandma's 89. She's about to croak. I know this sounds sad, but it's true. This is what people do. Grandma's about to croak. So if I give the property to grandma, right? She owns it now. And then she passes away. She leaves me as the heir. I get a step up in basis. Woohoo! No capital gains tax for me. Government ain't stupid. People have done this before. So there's a clawback when it comes to step up in basis. If you're it's called a 1 year transfer rule. If you're going to consider to do something like do a strategy like that, and I've even seen financial advisors tell their clients to do that. It doesn't work. Um, and the other thing is if you're leaving your assets to your heirs, and I don't know anyone in this chat, type of one in the chat if you're absolutely in love with your son-in-law or daughter-in-law. If you're absolutely in love with them, you think the world of them, you think they're the best, type of one in the chat. This is the point where you usually don't see a lot of ones in the chats. But listen, everyone's family situation is different. I mean, no ill will. But the point is, if you're leaving assets to your kids, their spouses, right? They're part of a partnership with their spouse. And anything that you leave to your kids, you're leaving to your son-in-law or daughter-in-law. So if you don't have the right provisions and things set up, and that son-in-law or daughter-in-law says, I'm going to divorce you now and take half because I know you're getting a whole bunch of money left behind for you. There's nothing you can do. Okay. So it's so important to kind of understand. We talk about the five pillars structure, how you're doing stuff with the entities and stuff that you have set up to prevent these types of things from happening because the reality is money does change a lot of people. Okay. It can either make a person that's very good and kind-hearted and giving better, or it can make someone who's really scrupulous and miserly and selfish. It can make them even more selfish. That's just what it does. It's like pouring gas on a fire. So joint owning with kids, pitfall number three. Let's kind of go more in detail with that. So, yes, joint owning property with your kids can make it easier. This is the main reason why people do it, easier to help manage assets, right? Hey, I own the property with my kids. Something happens to me. I end up in a nursing home or this or that, or I pass away. It can pass to them. They can handle bills. They can pay the mortgage, right? Because they're co-owners. So it's in theory, it's a great idea and it makes sense. And sometimes this does shake out where it transitions over and there's no issues. But again, when we're talking about tax mitigation, right? Being efficient, using the tax code to your advantage, you get that step up in basis. That's what the government gives you. If you gift, sorry, if you co-own a property with your child, it is a gift for tax purposes. People don't know that. What does that mean? You actually have to file a gift tax return, guys. How many of you that joint own a property with your children have ever filed a gift tax? Most people, they're like, what? What's a gift tax? It's a gift tax return. They don't even know what that is. So you're supposed to do that because it's considered a gift. So why that's important, we'll get into estate taxes and what that means is it reduces part of your lifetime gift and estate tax exemption. And we'll get more into what that means. A lot of people don't think this applies to them, but it will, and we'll talk about that. But here's kind of how it works. So it reduces the stepped up in basis this way. So let's say same example, grandma or grandpa, dad, whatever, bought the property. The basis was $200,000. Okay, $200,000. Then he says, "Hey, Junior, you're gonna co-own the property with me." Okay. Now, when dad passes away, the fair market value is 1 million. Co-ownership means we both own half, but 100% at the same time. It's a weird concept, but that's what joint ownership with rights of survivorship means. So from a tax standpoint, what does that mean? That means the basis, Junior's basis is now 600,000. So they're looking at a $400,000 capital gain. That's an ouch, guys. It's a big ouch. Just because dad or mom or whomever thought it would be efficient for them to have them as a joint owner. On top of that, again, it's in your personal name, it's in their personal name. So they own half of that asset. So if there's creditors that come after them, if there's liabilities, if there's lawsuits, if there's divorce, Medicaid, there's a whole bunch of different situations. Guess what? Your portion is on the hook just as much as theirs is because you own it together. They could sell it right from under you. We've had that happen too. We had clients come in and say, I own this. My kid sold a $3 million property and I never heard from him again. Happens. So it's not that it's bad. There's different things that you can do to make sure that, hey, you have control. Because at the end of the day, reason what people are trying to do is to do things efficiently and manage things efficiently. Again, structures, strategy, leverage, timing, all these things, super, super important. Legal issues, okay? Big thing with people that have a big real estate portfolio is owning significant amount of assets or property in your personal name or even LLCs, corporations, or living trust. Hey, I got an LLC. I'm good. No one can sue me. I got a living trust. I got a land trust. I got a corporation. I'm good. I'm protected. No, you're not. Everything is in your personal name. You're fully exposed. I can go on the Secretary of State. My 10-year-old son can go on ChatGPT and find out everything about you in about 5 seconds. Okay? It's super simple. You're exposed to creditors, liabilities, and lawsuits. Just because you have an entity doesn't mean jack squat. Okay? Especially people in real estate. Okay? You have no privacy, especially now. Has anyone heard about the new FinCEN rule that's going to start March 1st? Go Google that. The same thing that was happening to businesses now is going to be happening to people in real estate. You're going to have to file basically through the federal government, your ownership. So having things in your personal name and just out there is not a smart deal. Wealthy people don't do that. Okay. They do things differently. We'll go into structures and kind of how that works. But living trust, LLCs, corporations, it's all part of your personal estate. You own it while you're alive. Once you're dead, different, but it's still part of your personal estate. Medicaid spend down. A lot of people don't know about this. Okay. If you need nursing home care, it's not so simple as, hey, I'm going to just go qualify for Medicaid, show them I'm broke. Nope. They're going to look at every single asset that you have, every stock portfolio that you have, every real estate investment that you have, even the real estate that you've hidden in all these LLCs. They will find it. They're not stupid. They can find it very quickly. Okay. Even Roth IRAs. A lot of people think Roth IRA, I'm good. I don't pay any taxes. I don't have no required minimum distributions. I'm good. Guess what? We're going to make you spend that sucker down because to them, it's just a big pool of money. Again, people just don't understand how these things work. Filial responsibility. This is something you're going to have to check your state with. Every state is different. Okay. Our state, our great state of North Carolina has this doctrine. Okay. But essentially, this is a carryover from years ago. It requires the adult children to financially support their parents if they're elderly and they're unable to provide for themselves. And this is only about medical care, guys, not their mortgage and all that stuff. But hey, mom or dad, grandma or grandpa, they have to go to a nursing home. Medicaid's gonna spend, five, 10, $15,000 a month. People don't realize how expensive nursing home and long-term care is. It's hella expensive. I had a client from California reach out to us a few months ago about $18,000 a month at it's a nice place, but crazy. Anyways, the government is going to make you spend down all your assets. That's how Medicaid spend down works. But for the kids of the adult children, if the government sees that you have the ability to pay, support your parents, and you don't, the nursing home can actually sue the kid that has the most money. Again, it varies from state to state. Every state has different rules. You can check. A lot of attorneys don't even know about this rule, filial responsibility. It's coming up more and more because people are trying to dodge Medicaid and the states are bleeding for money and they're trying to find ways to get you. But again, this is having things in your personal name, owning things in your personal name, in your personal estate. Ownership is not your friend. And so while you're alive, you want to do things efficiently. When you're selling and you're exiting, you want to do things efficiently. And when you pass away, obviously, you want to do things efficiently. But it all starts with proper planning. And this is something people don't know. Estate taxes. We'll briefly kind of go over this. A lot of people do not think estate taxes even apply to them because they think, hey, I'm not at that high Uber net worth. I don't have to worry about it. I'm not super, super wealthy. And they don't understand how estate taxes work at all. But basically, right now, the basic exclusion limit, which is the same as the lifetime gift and estate tax exemption, government just likes words and acronyms, but it's the same thing. Okay. So right now, that amount is $15 million dollars for a single person, $30 million dollars for a couple. So if I have $10 million dollars worth of assets, my net worth, real estate, businesses, stocks, all that stuff, I am below the threshold for right now. So I don't have to worry about estate taxes. But what is the hope? The hope is that when you invest and when you put money away and you're smart and diligent, your income, your net worth is going to grow over time. So although you may not be in an estate tax position now, number one, estate tax rates change over time. They just do. It was set to go down back to 3 million. Then Congress changed it. But guess what? Congress can change. We talked about that. Tax laws change at any time. A lot of people like to get into politics. I don't. I tell people I'm not a red guy. I'm not a blue guy. I'm a green guy. Keeping my green and keeping your green. And the reality is, politicians, they play a much different game than we do. They live in a completely different world. They make the rules, we follow them. If they had to live in our world for one day, they'd blow their brains out. So you have to kind of understand how to use everything to your advantage. But the reality here is a lot of people think they don't qualify, they don't have to worry about estate taxes because they're not at that net worth. Again, number one, your net worth can grow over time and put you into a taxable territory later. Number two, we already talked about joint owned assets. We had a guy a few weeks ago got about maybe $7, $8 million worth of real estate. He's like, yeah, me and my son own some properties. Like, how much? He's like, $7, $8 million worth. It's like, how many properties is he on? He's got properties in North Carolina and Virginia. He's like, all of them. I'm like, did you realize that you just gifted your son about $4 million? He's like, what? Like, yeah, that's what you did. So when you gift that that eats up. And when the tax laws change, when the exemptions go down, if you don't lock it in, you're screwed. And so a lot of people have actually put themselves up into the estate tax area just for these reasons. There's so many different reasons. The big thing to understand with estate taxes is number one, Uncle Sam gets his cut first. Okay. Bills get paid, the debt gets paid, and then before it goes, it's not like with regular taxes, how, hey, I get my tax, and at the end of the year, I write a check to Uncle Sam. No, Uncle Sam gets his cut first, and you only have 9 months to play, which is a very short amount of time, especially if you have illiquid assets. If a lot of your investments is tied up in real estate, in businesses, and private equity, it might have to be sold at a discount. You might have to try to get some loans. We see horror stories all of the time, or at a loss, fire sale, which is devastating. I mean, it's a waste. You work so hard, and then now they're going to sell it for nothing because you didn't have the money to pay the estate tax. And here is the big thing that a lot of people don't realize. Point number seven. There's many states right now. There's 17 states that have a estate tax. Say estate tax. Say that 7 times fast. They have a state inheritance tax. What does that mean? That means the state is going to tax you on top of the federal government. Or even if you don't meet the federal government rules, the state has a state tax. Kentucky is one of them. Connecticut's one of them. Maryland has two state taxes. And guess what? That state tax, that state estate tax is based off of the state where the assets or the properties are in, not your state.
Mhm.
So a lot of people think, oh, I'm in Florida. We don't have any estate tax. I'm in Texas. Doesn't matter where you live. You're inheriting assets. You're inheriting businesses, property, real estate, whatever, from a person who was domiciled in that state. And now the state is going to ask you to cut a big check and they're going to get it. And a lot of people, boom, have no idea. And those thresholds are much lower than 15 million, 30 million. I think Kentucky's is like what, $1,000 and that's it. $1,000 they let you keep after that. And they tax it much higher. 5, 10%. It's ridiculous. 16%, I think, is the highest one. But this gets people all the time because they don't understand how the system works. And guess what? You have the 5 pillars, you have the strategies, you have the structures, have everything in place. This can all be avoided. Liquidity. This is the last pitfall we'll go over, but this kind of ties hand in hand. But liquidity planning is super, 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 super important. If you've built out any significant amount of wealth, you need to have liquidity planning because even if your heirs avoid probate, they don't have to worry about probate. Oh, we got trust, we have everything set up. We don't have to worry about estate tax. Our net worth was low. We didn't have to worry about estate tax. Guess what? They're still going to need money. They're still going to need money for everything that you left them. You left them a huge real estate portfolio. You left them a whole bunch of multifamily properties, this and that. But guess what? Your kids have their own stuff, right? They have their own house. They have their own boats. They have their own this. And so now you're going to ask them. And I know a lot of people have different emotional feelings about this. We're not going to have that conversation right now. But the reality is what's going to happen is they're going to say, I don't have the money to pay for the property taxes and the mortgage and the utilities and the insurance and the maintenance and all that stuff, right? And there's going to be a whole bunch of family fights and this and that about who's getting what and who's going to pay for this and who's going to pay for that because there is no liquidity. There's assets, there's net worth. And we've met a lot of people that have 20, 30, $50 million net worth they're leaving behind, but no liquidity. It's real estate, it's all paper stuff, and it's going to take time for things to get divvied out. So if you leave your kids only illiquid assets, real estate, businesses, private equity, with no monetary provisions, they will be screwed.
And this happens a lot also with spouses that have businesses. This happened personally in my family. I had a cousin that recently passed. He had very successful business, very affluent man, a lot of employees. Wife couldn't access the money, didn't know how to pay everything. There was no liquidity provisions left. It's just an absolute mess, nightmare. So we see this a lot,
Yeah,
unfortunately.
yeah,
So if you have a spouse, if you have a business and you have a spouse and you don't have a liquidity provision set up for that spouse, it takes a while sometimes for a death certificate to be issued. And if you have a business and you have to pay employees, you want to make sure you have liquidity provisions set up and they understand what to do and how to do it because it's a really sad situation.
yeah. Super sad, unfortunately. I mean, people, I think the thing is people don't they in their mind's eye, they talk to an advisor, they get a plan, they think, oh, this is how things are gonna pan out. They don't realize how things work in the real world, right? How long does it take? We set up TOD or POD accounts for our brokerage accounts and things like that. It could take 2 to 6 weeks to transfer over, even if you've done all the paperwork right. Oh, we have a trust, we have life insurance. Yeah, I've been in the insurance industry since 2006. Insurance can take 1 to 6 months. They'd love to drag their feet to pay out, right? If they go through probate, they're even screwed even more. So that's why you want to, if you have any type of wealth, get a trust, get all these different things set up so your family can avoid that. But even if you have everything set up right, their liquidity is foundational. You need to have provisions. Hey, once something happens, you pass away, whatever, we have money that we can access right away, pay this stuff, pay the bills, pay this, so that it doesn't go into default. We don't get calls from the banks. We don't get creditors. We don't have to sell it for a fire sale, right? We can sit and take our time and sell whenever we want to sell, and we're not beholden because we're running out of money. And this is what happens to a lot of wealthy families that do everything right. They're great at making money. They're great at building wealth, but when it comes to keeping it, they have no liquidity planning done. So let's get it. We're going to get into more strategies and more in the meat of a lot of what we're talking about and how to put this stuff together. But I want to go over some of the traditional strategies when it comes to capital gains and what people do. The first way is, and I say this kind of tongue in cheek, but I mean it in all honesty. For a lot of people, it may just make sense for you to pay the tax. Okay. Why? It's simple and easy, right? There's no planning, there's no attorneys, there's no fees, there's no this or that, there's no tax filings. Um, and for a lot of people, it's just, hey, I just want to take this money, whatever I've gained, I'll ride off into the sunset, go to Mexico, go here. Well, probably not Mexico now, but whatever. I'll go wherever and live the rest of my life, and I can do whatever I want with the money. I've paid Uncle Sam their fair share, and that's it. So it is simple and easy. Obviously, this is the default position, right? If you don't do any planning, Uncle Sam's going to take their cut. But for a lot of people, hey, your tax liability, you're looking at maybe a 10,000, 20,000, maybe 30,000 tax liability. Maybe it doesn't make sense to go through the rigmarole and set up an advanced structure or strategy because the tax liability right now for the asset that you're selling right now doesn't warrant it. Maybe in a few years, hey, I'm selling, $3, $4 million worth of real estate. All right, maybe it makes sense now, but for right now, maybe it may make sense for you to pay the tax. Obviously, no long-term restrictions, commitments. Hey, I don't have to tie this up in a real estate portfolio or do this or do that. But at the end of the day, if you're paying tax, less money now means less money working for you, right? This is opportunity cost. This is the time aspect of the pillars, right? Every dollar that you pay in taxes, dollar that you lose forever, and the opportunity cost of that dollar is gone. What you could have done with that. That is super, super important. Obviously, if you pay the tax, you have less money, which means you have less leverage. We're going to talk about leverage. Leverage is probably one of the most important things for people that are selling their assets because this is what allows you to not only, if you're doing things right, reduce your taxes, but now we can use other people's money to grow our wealth even more. But if you have less money, it's less leverage, right? Um, but the big thing, this is, and I've had a few clients that have come to me after they've sold it. Hey, I sold this. I paid the capital gains tax. What can I do? There's maybe a few different things we can do for them from on going forward, so that they don't pay taxes ever again. But all the money that you've paid taxes on, once you receive that money, if you're going to go this route and pay the taxes, once you get that money, number one, protect it. Number two, keep control. Number three, be able to use it for leverage and don't put it back into a place where it's going to be continue to be taxed. This is what people do. They go, hey, I sold my real estate portfolio or I sold my stock portfolio. I'm going to go into crypto or I'm going to go into this investment or that investment. That's fine. I don't care what you invest in. But if you're putting it in the structure, right, in your personal name, in an LLC, in a corporation, in a living trust, where you're always going to pay tax, it makes no sense. It makes absolutely no sense, and you're constantly exposed. You're going back to the same game over and over again. We meet very wealthy people, very smart people, intelligent people that make this stupid tax mistake because they just don't know what they don't know. And so if you're going to pay the tax, that's fine, but don't pay the tax again because we'll get into that in a little bit about the IRS rule, very simple, basic IRS rule that people don't understand that legally allows you to not pay taxes ever again, but it's what you're doing with your money. So that's strategy number one. Number two is the installment sale. Now, the installment sale, seller financing isn't available to everybody, right? If you're selling, a stock portfolio, you really can't do an installment sale, right? If you're selling, some crypto investment, can't do an installment sale. So this is mainly going to pertain to closely held businesses and real estate. Hey, I'm looking at a huge capital gain. Let me try to find a way to spread the tax bill out over time by financing the deal. I'm going to be the bank. I'm going to loan this money out to the new buyer. And that's how they're going to pay me. They're going to pay me over time, 5 years, 7 years, 10 years, whatever it is. And I won't have to worry about a huge capital gain. I'll just pay it over time. So it does ease it, right? If you're doing installment sale, seller financing, it does ease the tax pain a little bit. But at the end of the day, you're still going to be paying tax. Number one. Number two, there's no liquidity. All the money's tied up there. Number three, and this is a big thing people don't understand, depreciation recapture. A lot of people, again, for every gimme, there's a gotcha. And there's so many people that don't understand when you do an installment sale, you can defer that gain, but you cannot defer that depreciation recapture. It's got to be paid right away. It's taxed as ordinary income in the year of the sale, and that's it. And a lot of people don't realize that until like the closing table, like, oh crap, really? Yeah, $2 million worth of depreciation recapture we had last week. I didn't understand. We helped them with a different a strategy that helped mitigate it. Um, Now another thing is installment sales for some sellers, it's their only option because maybe they have a relationship with the buyer. A lot of times this happens with closely held businesses. Someone has an employee that's worked for a long time. They understand the business. They want to do a buyout, whatever. Or there's so many different circumstances where this is the case. Maybe the buyer can't find the money. Banks aren't loaning money, right? It's hard to qualify. So there's all these different things where an installment sale is probably the only strategy that will work, but there are more efficient ways to do it where we can mitigate a lot of these risks because again, lack of liquidity, um, can't defer that depreciation recapture. If the buyer defaults on the loan or prepays a loan, it's a big thing, huge tax problem. A lot of people don't realize that when they go into installment sales. So there's a big risk there. Interest income, you're taking the capital gain over time and you're taking interest income. That interest income is going to be taxed. And the big thing, obviously, we're in an environment where interest rates have been kind of crazy, going up, going down. If interest rates go up or if tax rates go up, it really kills the whole deal because the whole thing of the installment sale is I'm going to pay this over time. But if over time the tax rate goes up, so does your capital gain, so does your interest income. It destroys the whole thing. You actually end up paying more tax than if you would have just sold it in one fell swoop. So having liquidity at the end of the day is your best friend, and there are ways to kind of structure income over time through like a kind of an installment sales strategy, but to mitigate all of these risks. And we'll go into kind of some of those strategies in a little bit. Loans against an asset. Okay. Loans are a great way to leverage, right? We're going to talk a lot about leverage. Leverage is great. But obviously, you have a huge capital gain. You only have a few options. Do I sell this all at one time? Do I do an installment sale if you can, business, real estate, or maybe I take a loan, right? Why? Because loans are not taxable. That's part of the tax code. A lot of people understand that. We'll go into leverage and why loans are such a huge thing. It's just how you do it. But the thing to kind of understand is number one, if that is your game plan, number one, what kind of collateral or down payment we have to put down, especially if you have real estate. For a lot of people, a lot of banks loaning out to real estate, they love it on the investment side. On the other side, not so much. What are the interest rates going to be when you get that loan? And the biggest thing is this: do you want to get out of the real estate that you're in, or do you not? Right? Because if you're going to stay in it and take a loan, you still have expenses, you still have costs, you still have all these things that, we call it tennis, toilets, and trash, right? That you have to deal with. So if your only strategy or your mindset is, hey, I'm going to take a loan to mitigate taxes, you still got the property. Do you want to get rid of it or do you not? And what happens if the property value goes down? Then you're really screwed. And your kids are probably even screwed more if they inherit it. So, not a bad strategy. We like loans, we like leverage. Leverage is good. The right leverage is even better. And we're going to talk more about that. Self-directed. A lot of people do self-directed IRAs, 401ks. Now, for the purposes of what we're talking about obviously tax mitigation. We're not talking about Roths, right? Because Roths are tax free. Lots of other issues with Roths. We won't go into that. But we're not talking about Roths. We're talking about regular, traditional self-directed IRAs or solo 401ks. A lot of people will do this with their real estate investments because it mitigates the capital gains taxes and the rental income and all this stuff, right? You don't have to worry about that because it's what? Tax deferred, tax postponed. We like to say that's really what's happening. You're postponing the tax. So it seems efficient because you're not paying taxes on that income every year. You don't have to worry about, having to constantly buy other property and depreciate and all that stuff. But when we think about this logically from a very basic tax standpoint, it really doesn't make sense. Because if you're, especially if you're doing buying and holds, if you're doing flips, not so much, but if you're doing buy and hold things within self-directed accounts, you're avoiding a 20% tax to pay a potentially higher tax later. Makes no sense because that's what's going to happen when you take that money out. You're going to pay ordinary income tax, which are traditionally always higher than capital gains taxes for the most part. So it logically doesn't make any sense because you're going to pay 100% ordinary income tax when you take that money out. The other thing is it's locked away. That money's locked away until retirement. Obviously, that's the whole purpose of it is for retirement. But maybe there's some opportunities. Maybe there's another way for you to leverage. Hey, if I could get $100,000, I could 10x, 20x my money in 3 months with this new investment, with this new private equity or whatever deal my friend has, or something I heard on the news. You can't take advantage of those opportunities because it's locked in that retirement account. So leverage options, not so good. And the other thing is when it comes to leverage, a lot of self-directeds, a lot of what you call it, banks and private money lenders and hard money lenders will lend to 401ks and IRAs. But the thing is they're all non-recourse loans. So guess what? You're not going to have the best rates, and you're not going to get the best terms. Versus if you had actual collateral liquidity, right? The banks will give you much favorable terms when you have those options. But 401ks, IRAs, you can't do that. And then obviously you have required distributions once you turn 70, 70 and a half, 72, depending on your age. So that's another thing. The government, and we meet a lot of people, right, Michelle? A lot of people that have, really done well with their real estate investments. They've done a few things in their self-directeds, saved some taxes, but the bulk of their investments are in, LLCs, businesses in their names, and they're doing well with their portfolio. And they may not need that 401k or that IRA, right? They just did it really for the tax savings. Hey, I can contribute in this and reduce my tax bill every year. And now it grew. And now the government's making you take that money out. Why? Because for every gimme, there's a gotcha. And that's how it works with retirement plans too. Retirement plans, appreciation recapture, deferral, that's all it is. You're just kicking the can down the road. You're not really saving taxes. Um, and then 1031 exchanges, exchanges entirely, real estate exchanges. It's not just 1031s. There's lots of different ways to exchange real estate exchanges. This used to be a lot different back in the day. It used to be where you could exchange a business into a real estate deal or an airplane into art. There used to be a lot of looser rules when it comes to exchanges. Now the rules are much different. Um, but real estate exchanges in general and their variations, 1031 is probably the most famous one. But you have 721s, you have DSTs, you have TICs and triple net leases. These can be a great way to defer capital gains, right? I'm going to take the gain from this property, from this real estate investment, and I'm going to put it in this other real estate investment, right? To avoid the capital gains. Because you don't want to get killed with that 20, 30, 40% tax, depending on where you live. So it's a great way to defer gains, right? Hey, I'm not paying the capital gains now, but all you're doing is just kicking the can down the road. You're not really saving taxes. Okay, and we'll get more into detail about 1031s and 1041s, which a lot of people don't understand and know about. But 1031s, lots of nuances with them. The biggest thing is the guidelines and timelines. A lot of people don't realize you do a 1031, you got to meet those deadlines. The 45-day identification and the 180-day close, they are not playing. The IRS is not playing any games. And most
Yeah.
people don't realize that those deadlines are calendar days, not business days. So weekends, uh, bank holidays, the clock keeps ticking,
Yeah.
and
And you're restricted to what's on the market too. It's really
yeah, there's yeah. What are the cap rates?
not
What are you
very
going to get?
flexible.
The whole point is, and I talk to people all the time about this. I have nothing against 1031 exchanges. They're a great strategy. It's just people need to know that there's other options. And if you can do the same thing mechanically that you do with the 1031, defer. put it in another structure, avoid the capital gains, but do it much more efficiently where you don't have the guidelines and timelines. You don't have to be restricted to a specific type of property, where you actually have liquidity, you have use and control, right? Versus, hey, I got to leave this to a qualified intermediary. You have asset protection. You don't have asset protection with the 1031 exchange. It's in your personal name, right? That equity, that's part of what you own. And guess what? It's not available for your primary residence. So going back to what we talked about with the 121 exclusion, you can't use a 1031 exchange for your primary residence, only for a rental property or an investment property, anything that, is business or investment related. Second homes, vacation homes. If you flip properties, we have a lot of people that buy and sell. You can't use a 1031 exchange for that. So what are your options? Pay the tax? For a lot of people, that's what they do, and it's not available for crypto stocks, business interests. So what do you do when you have those assets? And so it's exchanging and finding ways to defer capital gains taxes now makes sense, right? Because if I can avoid the capital gains tax now, take that money, invest it somewhere, over time, I'm going to have more money than the tax bill I'm eventually going to have to pay or whatnot. So exchanging and deferring tax is good, but what if we can find more efficient ways to exchange? What if we can find more efficient ways to not only defer tax, but reduce the actual capital gain or eliminate the capital gain? That, in my mind's eye, is a much more efficient way to do things. The big thing about 1031s, and this is what I like to tell people all the time, is that the government isn't stupid. This is an article, you can Google this. This came in 2021 from the National Association of Realtors. And if you read this really carefully, this is an entire article. At the time, essentially, what happened is the government was mulling over 1031s because here's the thing. What is the IRS, what does the government get when someone does a 1031? What do they get out of it tax wise? Nothing. They get nothing. The taxes are deferred. So they get no money, no revenue, no nothing. So the government's like, do we keep this 1031 thing going on? That's what and the National Association of Realtors, okay, has all this data. What do they say? They say, no, government, don't get rid of 1031 exchanges. You know why? Because you actually make money. Why? Because 88% of 1031 exchanges, and this is what people don't realize, they ultimately end up as taxable sales. Why? Because grandma, grandpa, Joe, Schmo, whatever, who was just is deferring, exchanging. He finally got to a point where he's like, you know what? I don't want to deal with tenants, toilets, and trash anymore. And I want to live the rest of my life, take my money, go skiing, go to Hawaii, go wherever. And they ultimately sell before they end up dying, right? The whole swap till you drop. That's what 1031 exchanges are colloquially called in the industry, right? That strategy can work, but a lot of times it doesn't. 88% of the time, matter of fact. And so that's the truth about 1031 exchanges. I didn't come up with this article. National Association of Realtors came up with it. Okay, and this is statistical data. So they know what's happening. The reality is if you're doing a 1031 exchange, you're just postponing the tax bill. Eventually, if you live long enough, which I hope you do, right? You're going to pay the tax. So you're just kicking the can down the road. It really isn't helping you be more efficient. You're not reducing your tax, you're just delaying it. So we're going to get more into detail of advanced strategies, but I really want you, again, everything that we go over in this class is building blocks for you guys to understand how these things actually shake out. So let's go over some strategy concepts. And I talked about this earlier, but I really want to dig into this. Number one, these are what I call the two most important tax rules. Okay. And these are basic, elementary. You can go, it's right in the tax code. This is just how money works. This is how taxes work. Okay. Number one, the government only taxes income. Okay. You have an income tax return. Business income, personal income, trust income, whatever. It's income. They don't tax
If you're
profits,
taking notes, I'm sorry, if you're taking notes, write that down
right?
because
That's the big
that
writer
is a
down.
very important rule to understand. People aren't taxed,
It's
income is taxed.
yeah, and it's such a basic elementary. It's like, duh, I know it's an income. No, but do you really understand? Because if you understood this, this is what wealthy people understand. You'd be doing things a lot differently. This is what wealthy people do. This is literally the playbook right here. It's not in some cave or cabal. This is how it works. Government taxes income, not profits, not money, not capital, income. It's in the code.
That's right. And the ultra wealthy in this country understand that. So their main goal is to mitigate what the government considers income. And that's what we suggest you do as well to
Yeah.
protect and have more.
And there's lots of different ways to mitigate that, right? A lot of people will use deductions, right? You can use deductions, you can use depreciation, you can use deferral, right? But depreciation deferral is just a postponement, right? You're just postponing the tax. You're not really reducing it. So if we can look at exclusions to income, legal exclusions, we talked about the Section 121 exclusion for capital gains. Guess what, guys? There's tons more exclusions than that. This is what wealthy people understand. Okay? Exclusions, allowances, exemptions, products, structures. We're going to get into that. These are things that are going to allow you to mitigate what the government considers the income, and now you're not going to be taxed. We have clients that are pulling in $800 million a year cash flow and not paying taxes legally. It's not tax evasion, it's understanding how the tax code works. Okay? So that's number one. Number two, the government says you only have to pay taxes on income one time. One time. And that is when it's earned, right? That's why it's called earned income, right? W-2 income, that's earned income. 1099 income, that's earned income, right? Capital gain income. So once you earn that income, after that, it's entirely up to you what you choose to do with your money. And here's the thing that most people do. Again, people that make a lot of money, very wealthy, very successful, have lots of real estate, have good advisors. They put it in places where, hey, I made this money. I worked a W-2 job. I have a business. I have rental property. I worked hard. I made all this money. Now I'm going to go take this and put it in a brokerage account. Or I'm going to take it and go put it in some oil and gas investments. Or I'm going to go take it and put it in some stock portfolio or 401k, where I'm always going to pay taxes if I make money. It's a guaranteed way for me to pay taxes. It's like we're trained to do these not so smart things. We think they're prudent and smart, but it's just not. So again, I don't care where you invest, stocks, real estate, crypto, doesn't matter. Understanding the five pillars, where your money is just as important as what it earns. And we have people that are making, I got a guy who makes $18,000 a month of rental income, not paying taxes. Why? Because it's in the right structure, right? So it's just how you do things that's such an important thing. So where number one, government only taxes income. Number two, what are you going to do with the money once you earn it? Are you going to put it in places where it's always going to be taxed, or are you going to move to a tax favored environment? And that's what we want to show you guys how to do. This is what you really have to be focused and concentrated on how to do. And unfortunately, advisors, CPAs, this is not the world they live in. You would think it is, but it's not. All right, so we talked about two most important tax concepts. Now we're going to talk about two essentials to mitigate capital gains. And this is a big thing when it comes to understanding how these structures and strategies work. So a lot of people, when they look at this stuff, again, oh, am I going to get audited? What's the risk? Everything is all black letter tax law. We have private letter rulings. Everything's, you have to understand all these wealthy people, the Kennedys, they're not doing this for no reason, number one. Number two, these are the people that actually have the money that if they get audited, they have the attorneys and all that stuff to fight it. So you have to understand everything in here is up to snuff. But again, understanding the concept. So the number one thing to understand when it comes to capital gains mitigations is a concept called or a doctrine called constructive receipt. And a lot of people don't understand it. Type of one in the chat if you've ever heard this term, constructive receipt. Type of one if you've heard of it. Type of two if you're like, I've never heard of this, or what the heck is this? Because I want to find out from you guys who know about this. A lot of people don't know what constructive receipt is. Type one in the chat if you've heard of constructive receipt. See some twos. See some twos. What is that? Okay. All right. So let me go into constructive receipt. So constructive receipt is essentially how the IRS, how the government looks at income from a 30,000 foot view to determine whether it's taxed. There's a whole concept called ascension to wealth, all that stuff. I'm not getting into that. That's too technical. But essentially, a constructive receipt basically means that you're taxed on income as soon as it's credited to you or made available for your unrestricted use, even if you haven't taken or touched the money yet. So in real estate, this happens all of the time. And if we understand kind of how 1031 exchanges actually work and why they're not so efficient, once you have a check written out to you, it's in your name. Even if it's at the escrow office and it has not been cashed in your bank account, okay? It is constructive receipt. That is a taxable event. The government considers you to have that money. There's nothing you can do about that, okay? So there's so many different things that people don't understand, but this is one of the things that we have to mitigate and avoid is avoiding constructive receipt. And that can only happen when we're setting up these strategies and structures way in advance. And so time, and we're going to talk about timing in a little bit when we go deep into the 5 pillars and all that stuff, is such an important thing. If you're even thinking about selling, I don't care if it's in a year, you need to have these things set up. We're about to exit from a very, hopefully, very profitable IPO in the next few months. And we had this stuff set up for about what, 2 years now, Shelley?
Hmm.
Yeah. Why? Because this is what you have to do. If you're just doing this at the 11th hour, your options are limited. There's not a lot of time, and it's just it's not a good thing. So you need to have a lot of runway. The more, the merrier. We can still, hey, if I'm closing in, 60 days, 30 days, there's some things we can do, and we'll talk about that. But this is such an important thing. So you have to avoid or minimize constructive receipt. That's number one. Okay. And that's how the wealthy use these tax structures to avoid getting killed with capital gains tax. This is the whole concept with the 1031 exchange. Because if you do a 1031 exchange the right way, the only way you can avoid that is if you have what? The qualified intermediary take the money. It can't go from escrow to your name. Once they write the check out to you, you're screwed. So you have to have all that stuff set up for 1031 exchange. It's really no different than with any of the structures that we talk about. The second thing is self-dealing. And this is a huge thing as well because self-dealing, and you can Google both of these things, ChatGPT, Gemini, doesn't matter. Self-dealing is a concept, a doctrine really with the IRS that they're really hard on. Anytime you hear self-dealing, you look at tax code cases, this and that, it's never a good thing. But essentially, if you have control over a tax favored entity, like a charity or anything like that, right? That the government they incentivize, right? They give tax incentives and benefits to these entities and these structures, but you're using it for your personal gain. Hey, we're gonna go buy a yacht and go take it out to Miami or do this or that. We don't want that. Okay. So minimizing your use or your relatedness to the entity in and of itself, those are the two things. I could get very deep into this, but the whole point is these are the things that are gonna cause you to, if you're doing it right, to be able to either defer, reduce, or even eliminate capital gains. We have a lot of strategies that work really well for people where we're actually eliminating a huge chunk of that capital gain. Gone, done. That's a huge benefit for people that have highly appreciated assets is, hey, we can eliminate half the capital gain. Yeah, let me see. So, taxes and retirement. This is a very important thing, a concept to understand as well, because we have a lot of people. They're, getting rid of their properties. They're exiting from their investments, and they really want to get rid of the tenants, toilets, and trash, and move on to cruises, cocktails, and Corvettes, as I like to say. But when you're in retirement, right? Most people in their mind's eye when it comes to investing they rely on deferral strategies, 1031 exchanges, right? 401ks, IRAs are the big one, right? Because the mindset is they're going to need less income in retirement, right? So just kick the can down the road. But for business owners and investors, that's never the case. You're never going to be in a lower tax bracket if you keep doing what you're doing, which is being successful, making more money. So they usually stay in higher tax brackets and they want to maintain their lifestyle. or have even better lifestyle. I worked my butt off all these years. I don't want to, eat dog food and sit in an apartment. I want to go travel. I want to do this. I want to do that. Right. So it's actually the inverse, the opposite. You're not like the typical W-2 employee guy that's just going out to Acme Co and bumping out widgets. You're creating things, you're innovative, you're employing people. And so it's just a different things. But when you're doing things like average people do, like 401ks and IRAs, you get what you get. And the reality is, even if you did everything plain vanilla, right off the bat, most business owners and investors are actually going to be paying higher taxes in retirement if you did nothing. Why? Because you lose your deductions. Your house more likely is probably paid off or close to being paid off. Your kids are out of the house. You sold your business, so you don't have any more business deductions. You're required to take, again, this happens to a lot of people in real estate. You have to take money from your 401ks and your IRAs. You have those required distributions. And then you got taxes on your Social Security and Medicare. A lot of people don't know about that. Pay more for Medicare, more for, your Social Security's tax. It's crazy. So right off the bat, a lot of people, even if they just they're not extravagant, they end up being in a higher tax bracket in their retirement years. So having control, again, tax control of what the government considers income, reducing future taxable income is paramount if you're an entrepreneur or you're an investor in your later years. We have clients all over the map from, young as, we just got a new guy, 25 years old, guy makes about 7 million a year. It's ridiculous what people are making. But it doesn't matter what age you're at, but for people, if you're looking at, your time line is, next 10 years, 5 years, you really need to start planning things differently. So let's go into our first structure. We're going to go over five structures, really two structures, and I'll show you why in a little bit. But don't want to inundate you. This class could last 3 hours, longer than that if we went over every strategy. But the first strategy, advanced strategy that we're going to be going over is what's called a philanthropic LLC. Okay, and this is a tax advantage LLC structure that has charitable intent. So this is not a 501(c)(3). This is not a private foundation. This is not any type of philanthropic entity that you would think of. It is an LLC that does have a philanthropic or charitable component to it. So the basis of this strategy and this structure is an LLC. So how does it work? So what we're using is we're using the LLC structure, but LLCs can be taxed in many different ways, right? They can be taxed if they're a single member as an S corp or a C corp or a single member disregarded, or they could be taxed as a partnership if they're multi-member. So that's what this is. This is using the multi-member LLC structure. So they're going to be filing a 1065. But this is not using a trust. We're going to get into trust next with the 1041 strategy. But this is using business law. So we're using all the laws that pertain to LLC and Uniform Commercial Code with business law. So it's an LLC, but it's a partnership. So it's a multi-member LLC where you are the managing member. So with LLCs, there's different types of LLCs. There's, family limited partnerships. There's limited liability, limited partnerships. There's all these different types of partnership structures. But this structure is an LLC where you are the managing member, where you control and operate 100%, but you only have 2% ownership. Okay. So you have just enough to give you that control and give you a lot of the benefits of an LLC, but majority of it is owned by a charitable entity. This could be a donor advised fund, it could be a private foundation, it could be a charity. There's different ways to set it up depending on your state and all these different things. There's different ways that our back office will set this up for you, the attorneys. But essentially, how it works on the left hand side that you see here is that's the structure, LLC, again, majority owned by the charity. Why is that so important? Well, what do charities get that not a lot of individuals get?
Tax exemptions.
Exemptions, right? We like exemptions. We like allowances. We like exclusions, right? So
Mhm.
what happens is you're going to take an asset, you're going to donate it, number one, to the LLC. Remember, the first line, everything here runs through the LLC. It does not run through the charity. LLC first. It just happens to be an LLC, partly owned by you, majority owned by that charity. But remember, it is a limited partner. It has no voting rights, no stock, no nothing. It's just an investor. When you donate that asset, guess what? There's lots of different things when it comes to valuation and all that stuff. Everything has to be above board with the IRS. Again, we're using the tax code, but that gift that you give gives you what? A charitable deduction. That's good. We like deductions. So the first thing you're going to do is give that. Now, one of the things to understand is that when you give that gift, it is irrevocable. Irrevocable, irrevocable. You say tomato, I say tomato. So you can't take it back. You give it, and that's it, right? Um, but again, you as the managing member, you maintain control over the investment decisions, time of sale, cash flow, all that stuff of the LLC. You're going to get the charitable deduction, again, based off of the percentage of ownership that charity has. But here's where everything really works out for people that are using this strategy is because you only own 2%, any income, any sales, any gains that are coming from that LLC, you're only paying taxes on your proportional percentage of ownership. So in the example that you see right here on the left-hand side, we're looking at a $10 million asset sale, basis of a million, gain of 900,000. They didn't do anything. Again, just assuming 30% taxes with state tax and Obamacare tax and capital gains, looking at about $2.7 million. Okay. But now, again, you only own 2%. What's 2% of 10 million? 200,000. So you're only paying taxes on that portion, which is 54,000. So $54,000 in taxes versus $2.7 million in taxes. I'll take that any single day. Now, the money is in the LLC. LLC has all of the assets. LLC sold it. So gifted the asset to the LLC. LLC sold it. All the proceeds go back into the LLC. Doesn't go to you. Goes back to the LLC. Income passes through you. So majority of that income is now in that LLC that is majority owned by that charity. So a lot of people say, okay, great, I avoid the tax. I got a tax deduction. You carry it forward, all this stuff, great. But how do I use the money? Again, this is where understanding how leverage works, how the tax code works, how all these different things works. Because what we can do is we can collateralize, give you some liquidity against the LLC, not the charity, the LLC, to access money, right? And so now we can use loans, we can use leverage to get money out of the LLC, suck money. And what are loans? Are loans taxable? Type it in the chat if what you know the answer. What are loans? Are loans taxable or not taxable? Type it in the chat. Taxable or not taxable? Bingo. Got a few. Not taxable. Yes. Tax code says that. Loans are considered cash flow. Okay? That's what wealthy people understand. It's what banks understand. We're going to get into that. So this is a strategy that can work really well with asset sales of pretty much any kind. You're selling a business, you're selling a huge stock portfolio, you're selling crypto. We have a lot of people in crypto that use this. Um, Businesses, doesn't matter. The thing to kind of understand is again time frame. Got to have the time to do it. Got to have the bandwidth, and really understand how the strategy works. But this can work really well to mitigate capital gains taxes when you
And a
start.
lot of people, when they hear loans, they think, oh, I have to pay it back. Do you have to pay it back, Stefan?
Yes and no. So yes, you do have to pay the loan. There's notes, there's contracts and all that stuff drawn out. But again, because of how we use leverage, and I'm going to get into that. we're going to use Uncle Sam's money to pay that loan off. And so that is such a huge component to this. All right, let's go into the 1041 exchange. 1041 exchange is a very simple thing to understand, but it's something that people don't understand a lot. Because what are we doing? We're essentially just using specialized trust structures that are designed for tax mitigation. Okay. So this is not your grandma's land trust. This is not a living trust. This is not a revocable living trust. These are different types of trust structures that you can use that are specially designed to mitigate capital gains taxes. I'm going to take a sip of water real quick because a little dehydrated, sorry. So 1041 exchange, that's what we're doing. There's different ways to do it, but let me kind of explain to you how it works and what we're doing. So essentially, we're setting up a specific specialized trust structure designed to sell assets, okay? Designed to take in business income in some cases. And it's really designed, obviously, from a long-term standpoint. When we talk about trust, typically we're talking about long-term, we're talking about legacy, we're talking about leaving assets for the next generation, which this entails. But these are trusts that you can actually benefit and use while you're alive. So this is not, hey, I'm putting money in a trust, I can do some things and then everything's for the next generation. No. These are trusts that are going to allow you to sell, not get killed with taxes. So right away, we don't have all the constraints of a 1031 exchange. And we'll go over the differences between these and a 1031. And once you understand it, you'll be like, oh my God, I'm never doing a 1031 again. But they'll allow you to sell, avoid the tax, keep more money, and be more efficient going forward. Okay. Now, there's different ways to utilize 1041s. The reason why they're called 1041 exchanges is because 1041s are the tax return for trusts in the States. Okay. That's all it is. It's a 1041 return. 1031, that's section 1031 of the tax code. The 1041s are the tax forms that are used for trust and estates. And so with all of these different types of structures, you will have to file a separate tax return for this entity. Same thing with the philanthropic LLC. And that's why we say, hey, strategies and all these different things, sometimes for some people it may be you pay the tax. You just do it because there's lots of different things that are involved. Bookkeeping, tax returns, bank accounts, all this stuff. You have to manage and structure these things and maintain these things the right way. But these are completely separate entities. Okay. The big difference between a 1041 and a 1031 is what you see at the top. 1031, only like kind. If I have real estate, I have to change it over to real estate. We have people that are using 1041s to get out of real estate and go into crypto or go into stocks, or vice versa, sell their business and go into real estate. Doesn't matter. You can exchange whatever asset into any asset because we're using a trust structure that allows you to do that versus a provision in the tax code that is very restricted. Okay. 1031 has a 45-day identification and 180-day close period. We don't have that. You can sell, avoid a tax, take your time, figure out what you want to buy, when you want to buy it. It doesn't even have to be real estate. Again, we have a lot of people, they sell their real estate portfolio and they sit back and they say, you know what? I don't want to do this anymore. I don't want to be a landlord. I want to go buy some crypto. I want to do life insurance. I want to do oil and gas. I want to do all these. Guess what? You can do it in a 1041 with a trust. Okay. Gives you much stronger protection because it's not in your personal name. Again, separate estate. If you want to limit exposure, we have to get things out of your personal name as much as possible. If you look at all of the wealthy people, it shows you some of the Kennedys, but it's not just them, the Bushes, the Waltons, the Walmart family, the Gettys, they have very little in their personal name. If you try to find their properties, you'll never find it because they don't own a whole lot in their personal name. It's all owned in these structures. Why? Because they understand the importance of privacy and protection, right? So that is a huge thing when it comes to 1041. It's just the protection alone. We have a lot of people that just for the protection, they say, you know what, I want this. I had a guy last year, a few years ago, He sold a chicken farm in North Carolina. His gain wasn't that big. It was maybe about $150,000. But to him, it made more sense to set this up because he had people coming after him. He had an ex-wife that wanted to get some money. He had some other people trying to steal from him. So he wanted the protection, make sure people couldn't get it. Um, and in the 1031, the big thing is it's tax deferral only. Okay. I'm only kicking the can down the road. All right. And again, nothing wrong with deferral. We like deferral. If we can delay when Uncle Sam gets paid and keep more money for us, that's more money that we can invest in and keep for later and grow. Right. So we like deferral, but what if we can actually reduce taxes? Some of the 1041 strategies allow you to do that, okay? Because we get actual tax deductions, okay? So there's different ways to do it. We won't go into detail, but I'll just go over these four different ways to do the 1041 exchange. We're going to start at the top left side, which is the installment sale trust, okay? Installment sale trust, again, if you're doing an installment sale, very similar. We're taking income over time, so we're not paying taxes in one foul swoop. But we're using a trust structure to do the installment. That's why it's called an installment sale trust. Very simple. Okay. So the way it works is you sell the asset to the installment sale trust. The trust sells it to the buyer because of trust provisions and how it's set up. The trust sells it to the buyer, all the income tax free inside the trust. So the trust doesn't pay taxes, which is good, right? We like that because of entity structures. But then you receive payments over time from the trust investments. And this is where you can get really, really funky and figure out how you're going to invest because we can structure that installment sale over a certain period of time that a lot of people typically don't do with an installment sale. Most of the time, an installment sale is like 5, 7 years. We can make that for 20 years, 25 years. We can make it very, very long. We can make the terms very favorable when it comes to interest. We could also have income come out that's not taxed because we're using leverage. We're using different types of things. We're using banks, right? So there's lots of different things that we can do inside the installment sale trust. But at the end of the day, it gives us deferral, gives us tax bracket arbitrage because we can control the income, and most importantly, gives you that asset protection. So this is a very efficient way if you need an income stream. This is a strategy that can work for you. If you don't need all the money all at once, hey, I just want to retire, I want to have some money come to me. We've had a lot of clients that do this very successfully and it works really well for them. The other strategy is called the charitable remainder trust. Charitable remainder trust, a lot of people get tripped up about this. If you Google online, you Google charitable remainder trust, you look at IRS, you'll see good, bad, and indifferent. You'll see everything over the board. And there's a lot of misconceptions about charitable remainder trust. These are very legal, number one. Okay, it's in the tax code, it's section 664. Okay, it has an old tax code dedicated to it. That's how good it is. And again, it's there for a reason, right? Who came up with this stuff? So typically, a lot of people think, oh, this sucks because yes, I'm selling, I'm avoiding the tax, but then I got to give everything over to charity at the end. That's not how that's how basic people use it, right? Advanced people, people that are smart, the wealthy people, they don't use it like that. So how the charitable remainder trust works is you're going to donate this. So this is a charitable entity. It's a trust structure. The way that this trust structure works is, and I don't want to get too deep into the weeds, but there's different beneficiaries. There's asset beneficiaries. There's income beneficiaries. The charity, you have to use a charity, a bona fide charity, not your charity. A lot of people I talk to, oh, I got a 501(c)(3). We just went over self-dealing. You can't do that. Okay. So lots of different nuances, but the point is, yes, there is a charity involved. There's a charitable purpose, which is why you get a deduction. And do we like deductions? Type one in the chat if you like deductions. Come on, guys. Type one in the chat if you like deductions. I got to see some ones. Yeah. We like deductions. So deductions are great. Okay. Which is why we use a charity within this structure. But the way this works is you transfer the assets to the charitable remainder trust. The trust sells the asset. First of all, the trust gives you a deduction, charitable deduction, once you donate that. Then the trust sells the asset. Money goes back into the trust, tax exempt entity, no taxes. And then it pays you an income stream. There's different ways to choose that income stream. We can choose it for your life. We can choose it for you and your spouse's life. We can choose it for a certain period of time. We've had people that literally take everything in the charitable remainder trust and wipe it down to nothing, okay, legally using the tax code, just because of how the laws are written. How it is written is yes, at some point in time, the charity has to get money that's left over, but what we utilize is what's called a wealth replacement trust, which basically says, hey, if something happens, let's say you set this charitable remainder trust up today and you kick the bucket tomorrow, right? Yes, in that event, if you're not doing things right, then everything will go to the charity, the rest of the remainder. But if we're using a wealth replacement trust, then yes, the money that goes to charity will go to charity, and then your heirs will actually get more, and they'll get more tax free, never have to pay tax because we're using leverage through the banks. And this is the key thing here when it comes to a lot of these strategies is understanding the tax side, but again, the liquidity side, the leverage side, structure, all of that matters. So charitable remainder trust, another way to do kind of an income play, but it gives you a lot more leverage than an installment sale trust when it comes to income. The other strategy, and this is one that we utilize a lot, is called the dynasty trust. Okay. The dynasty trust, a lot of wealthy people use this. We have the dynasty trust structure. We've used it for years. It's not just for the ultra wealthy. It is a very misunderstood trust structure, I would say. All of these trust structures are misunderstood, I would say. But this one in particular, just because of the fact that all of these trust structures are irrevocable, number one, which again means you can't take it back once it's in the trust. That's it. But again, that's how you get the asset protection. That's how you get the tax benefits. But the thing about this types of trust is that is a non-grantor trust. Okay. And this is the big thing that trips people up because most of the time people set up trust, whether it's a charitable remainder trust, installment sale trust, whatever, you're the grantor. You're gifting it. This is a non-grantor trust, which gives you a lot more asset protection, gives you a lot more tax benefits, allows you to have a lot more bandwidth with what you're doing inside the trust. So we utilize this trust to avoid capital gains. It's a little bit different. There is no charity involved. You are the trustee, so you can control and manage and make executive decisions, but there's no charity involved. So nothing's going to charity at the end. If you want to give money to charity, you can from your trust structure, okay? Because a trust can give a charitable deduction. I'm sorry, charitable contribution, just like an individual can. But essentially, what happens with this structure is that instead of donating, we sell assets over. So, very similar to the installment sale trust where we're selling the assets over, same sort of concept. We sell it over, notarized bill of sale, warranty, not warranty, purchase and sale agreement, deed, all that stuff. It's like a bona fide financial transaction. Once the asset's in the trust, then the trust sells the asset to the new buyer, and then all of the proceeds, same thing, goes back to the trust. Here's where this trust differs from a lot of the trust strategies that we use with the 1041 exchange is that now that money's in the trust because it's number one irrevocable, number two non-grantor, number three it's got discretional provisions in it. They don't have to use a complex tax codes. What does that mean? I don't have to distribute income every single year like most trusts. Pretty much most of the trusts out there they have to distribute income. Again, income is taxable, not at the trust tax rates. That's another thing that people don't realize. They don't understand about trust. They think, oh, I'm going to pay the trust tax rates. No, not if you understand how trusts work. So the big thing is the money stays inside the trust. I'm not required to take a distribution every year like I am with the charitable remainder trust or an installment sale trust. What does that mean? The money can stay inside the trust and I can utilize that to grow my investments more and more. I don't need to take income out. The second thing is that this type of trust, the ownership structure, because it's non-grantor, it's irrevocable. Only thing that you are is a trustee. So guess what? Any assets inside the trust, I have a ton of asset protection, number one. Number two, if I want, and this goes back into self-dealing, because we talk about not having beneficial interest. If I want to buy a house, a primary residence, and this is a big thing for people with real estate, especially 1031 exchanges, is that you can use a 1031 exchange, but it can only be It can only be for a business or investment purpose. I have a lot of people, they're selling lots or they're selling multifamily or commercial units, and now they want to take that money and go buy a house that they want to live in at the beach, North Carolina, or in the mountains or whatever. You can do that in with the Dynasty Trust, where you can reside and live in those assets. However, it's still not yours. You will have to pay a lease fee to use to live there and to utilize it. So you have to pay a lease to the trust, but it's not super extravagant. But the big thing is the trust can pay for all of the expenses now, and that's a huge thing. So if I have a
On a
house,
pre-tax basis, yeah.
yeah, on a pre-tax basis. So if I have a mortgage, the trust can pay for the mortgage. It can pay for the property taxes. It can pay for the roof. It can pay for the new driveway, the pool guy, the bug guy, the utilities. All of the expenses generated by that asset are trust expenses, and the trust is required to pay for that. And that's what a lot of wealthy people do. You hear the term trust fund babies? This is what
Yeah.
they do.
I want to just say one thing about it too. When you do the notarized bill of sale of the asset to the trust owes you what they call a demand note. Okay. So that you can have some liquidity. There's money within the trust that you can get back out to use for your fun, food, and fashion. So there are trust expenses. You can continue to go on with the trust expenses, Stefan, like your health care and all of that, and your children's education, and if you have any children that have special needs or therapies or anything like that, it will pay for both the trustees' expenses, healthcare expenses, and the beneficiaries' healthcare expenses. So there's a lot of benefits of it, but there is also some liquidity in it too, where you can get money. And you can also even draw a salary from it. You would pay taxes on that salary you draw to manage it, if you
Yeah.
so choose.
Yeah, yeah, lots of options. I mean, this one thing I will say is that this is a long-term strategy, and we meet again different strokes for different folks. Everyone's situation is different. That's why we do a lot of, one-on-ones, figuring out what's going to work because it's not a cookie cutter thing. But I will say that this is something, if you are really concerned about generational wealth, passing things on, this is something that you should highly consider because that's literally what it's designed for. That's
Yeah.
why they're called dynasty trusts. That's why
And you can
the
have a running
Kennedys had.
business. Your current business can be a partnership in a partnership with
Yeah,
a trust. There's a wonderful structure and way we can set that up for you to make the most of your money and keep more and pay less tax legally
yeah,
and protect
and
it.
that's a huge thing because as you see right there, yeah, we can redirect business income into this trust structure. So a lot of times we have clients that are selling one business, and if you're a business owner on the call, you probably know this to be true. They sell one business and they go into another one. It's like an addiction. Hey, I'm leaving. I had this guy. He's all over med spas. He's done with med spas, and he wants to do franchises, restaurants, whatever. It doesn't matter. So you can redirect income from businesses into the trust as well. But the big thing is that the income does not have to be distributed. We can use it again for education expenses for our kids. We use this a lot for college planning because it allows you to grow your wealth and really just expand things for your family. So we like it. Does it work for everyone? No, but it's definitely something that you should consider if you're concerned about generational wealth and you have big wealth transfers. Then we have the asset diversification trust. Okay, and this is very, very special. Now it's very akin to the charitable remainder trust because it uses the same code section 664, but is far from different than a charitable remainder trust, mainly in the fact of how the actuarial calculations work when it comes to giving money to charity. This is essentially it's guised as hey, the money needs to go to charity, but it's never going to go to the charity, and it does it legally using the tax code. But reason why it's called asset diversification trust is that this trust is really designed. It's kind of like if a dynasty trust and a charitable manager trust had a baby. So you transfer assets to the trust. This does give you a deduction because you get a charitable deduction. Um, it sells the trust, the assets tax free, but now the money's in the trust, and the goal is to diversify your portfolio. Hey, we were in real estate mainly. Now we want to do stocks. Now we do want to do crypto. Now we want to do annuities. We do life insurance. We need to do bank funded life insurance, all these different things. You can do that inside of this type of trust. Not that you can't do that inside of any other trust. You can, but this trust is really designed for that. And it gives you the tax deduction, the upfront tax deduction. So there's lots of nuances. I can go into detail about this. I think I've kind of exhausted what this is, but hopefully you guys understand by now when it comes to real estate, businesses, investments, whatever you have, there's 1031s, there's also 1041s. And the 1041 is not just restricted to real estate. So again, you're selling businesses, you're selling private equity, stocks, whatever it is, you can do that. Now, with all of these things, you do need to have this structure set up prior to closing. So again, proactivity, getting things done in advance, super, super important. If you're like, hey, we're closing next week, we have a letter of intent, probably can't do it. It's not enough time. So really understand that having these structures set up in advance is so important. You don't have to be selling next week or next month. If you're selling in a year, now is the time to start planning and getting these things in place so that when you do get those calls, get those offers, get whatever, it's right away. And taxes are off the table. It relieves the stress, makes things a lot smoother. So the big difference between the 1031 versus the 1041 is again, 1031, you have the 45-day identification rule. 1041, no. 1031, 180-day close. You can close whatever. Obviously, once you close a property, it's in the trust. You can do whatever you want. There's no time limit to you invest or not invest. It's entirely up to you. Requires a qualified intermediary. This is a big thing. You have to find someone that's not related to you, not self-dealing, none of that stuff, and trust them with your money. 1041, use a trust account at a bank. Money stays there. You're the trustee. You can see where everything's going. Gives you a lot more control. You don't have any ownership. It's still owned by the trust, separate entity, separate EIN, files its own tax return, separate books, bank accounts, all that stuff, but you still have access and liquidity to it. 1031, no asset protection. Yeah, you get a lot of asset protection when you're using trust. No privacy with the 1031 exchange, a whole bunch of privacy because we're using trust structures. Hey, I have my property. It's an ABC trust. I've named this trust. It doesn't have your name on it or anything. There's no filings required with the Secretary of State. Um, a lot more efficient if you want to be
This is
anonymous.
huge. The anonymity, this is huge for people because we live in a litigious society, okay? When you're working in a trust structure, it has its own EIN, it's its own entity. They can't take from you what you don't own. You don't own it anymore. Your trust does, but you're
Yep,
still controlling it. This is what the wealthy understand.
100%. Obviously, taxes are not just deferred with the trust, more tax efficient cash flow, depreciation recapture. That's a big thing with 1031s. You're just kicking down the depreciation. The more you depreciate and defer, you're just making that can bigger and bigger and bigger, and you get killed when you actually sell. And we've seen this happen all the time. And then obviously, you can do whatever you want within your trust. 1031 just keeps it, it has to be within real estate. So going back to the five pillars. So a few things we want to just kind of conclude and go over, and I want to show you some real life examples and strategies, and we'll get into the Q&A. So number one, again, having liquidity, access, use, and control, the most important thing when it comes to you selling your assets and avoiding taxes. Because if you're doing all this and hey, it's just in some real estate investment or over here, you can't bank the real estate. You can't pay your bills with real estate. You can't go to the grocery store with real estate. You need dollars. You need money. Your heirs need money, right? And so you need to be focused on leverage and liquidity because that allows you to not have to worry about fire sales and not have to worry about this and your heirs the same way. Leverage, using other people's money to grow your wealth. The more dollars that you have working for you, the better, right? That's what people in real estate do all the time. You guys understand this if you're in real estate. It's better to, put if you have $200,000, am I going to go buy a property for $200,000? Or am I going to get $1 million property and put $200,000? I can get more income with that, right? So leverage is super important because it allows you to use other people's money. Yes, I understand I pay interest, but interest is deductible. That's part of the tax code, right? And when you're really behind, and this happens a lot to people when they're in their later years, is I'm behind. I took a dip. A lot of people are still recovering from 2008 and even 2022, right? When the market went down. So when you're using other people's money, have more money at work, it allows you to catch up more if you're behind, not where you want to be. Structure, tax efficiency, asset protection, legacy planning, when they're all together, that's important. When you just have one, oh, I have the tax stuff, I got depreciation, but you got another $1 million, $1.5 million property. Talked to a guy last week. It's in your personal name. You got a write off and you have a liability sitting in your hand. That doesn't make any sense. Okay. So you have to be conscientious with putting all this stuff together. Strategy, making the right moves, right time, the right structures in place, and then timing. Timing is the most important thing. I'm going to say this over and over again. If you don't have timing, timing is the most precious commodity we have. We don't have enough of it. We don't know when our time's going to come. You need to be proactive. Okay, the longer you wait, the less options you have, and the harder it is to solve the tax problem. So you have to be proactive. So liquidity, what do we mean by this? So access to capital is your best friend. This is a client. Unfortunately, this is a lot of people like to show you the good stuff. I like to show you the not so good stuff. So this is a guy, their tax bill was $323,000. They paid it, nothing we could do. Okay, that was it. Okay, if they would have met us before, we could have saved them a lot of that, maybe 90% of it, not more. Okay, but it is what it is. Good news is that we're able to go do a few things here and there, amend their tax return. They got a check back for $172,000. So that's something better versus nothing. But what's most important now, he's got that money. Are you going to take that money and go put it in a real estate investment or go put it in a stock or a crypto investment where you always be paying tax? No. We're going to leverage that. We're going to use the bank's money to grow our wealth. We're going to do it in a tax-free environment, a tax-advantage environment. That's the type of things that you need to be looking at. So, but you can only do that when you have liquidity, when you have money. Leverage, using the bank's money, using other people's money. Okay, this is a big thing. A lot of people in real estate do not understand how to do this for their retirement, not just your real estate portfolio, but for your retirement, right? For tax-free income down the road. This is what wealthy people do. So if we look at this, this is what we did with this client. The seller, they paid the money. They avoided the tax on the sale. In this particular case, they avoided about, I want to say 1.8 or 1.7 million in taxes. So that's good. But now we're not going to take that 1.7 or 1.8. We're going to go invest in here in stocks and crypto or whatever. No, let's take a portion of that money. Let's go use the bank's money to grow your wealth. Okay? You can go use some of that money, go to Tahiti, go travel, but let's use leverage. So what did they do? If you look at the top right here, this is what they did with this structure. The whole time, what the seller who avoided that $1.78 million dollar tax bill, they paid $659,893 into this structure. They didn't do it all at once. They paid the bank interest. This is an interest payment. So if you look in the middle where the pink line is, this is the interest payments that they paid to the bank. Okay. So they paid the first year 41,512. What did the bank pay? $572,000. Okay. I put in 41, bank puts in 500. That's a good deal. Okay. So all through that, you can see through the year 77 and the next year 94, 114. So when you add all that up, that's 659,893. Okay. So that's what our client, the seller, they sold their property, avoided the capital gains. That's what they paid. This is what the bank paid in the yellow on the left
That's what
side.
they did with their money. That's what they did with the money that they
Yes.
saved. Yeah.
Yes. The bank paid $572,000 every single year for 10 years. It's a guy, 42 years old. He's in Colorado. Okay, pretty young guy. But here's the most important thing. The most important thing is because we're using the bank's money, we're using leverage, we're using the tax code, we avoided taxes. Now we're using the bank's money, other people's money to grow our wealth. We paid interest. We understand there's a cost to doing that, but we understand why. And the reason why is because we want our money growing, we want it to grow uninterrupted, compounded, and we want to be able to leverage it through loans, which is what we did. So All in all, he put in $659,000, and now he's going to be able to, once he's age 65, take $586,000 a year tax free for the rest of his life. I don't know about you guys, but that makes all the sense in the world to me versus just putting it in a place where I'm always going to pay taxes and I'm not going to have leverage. This is, again, this is the opposite of what most people do. They say, hey, I'm not going to use banks. I don't want to pay interest. I don't like loans. Dave Ramsey said that's bad. I'm going to pay cash for everything, for my real estate investments, for my business, for my retirement. I'm just going to put my cash instead of using other people's money. Why would you do that when the banks, when the wealthy people, this is what they're using? They're using other people's money to grow their money because they understand how taxes work and how the banking system works.
And how to leverage
Structure
their money. Yep.
and leverage. Leverage is this is the key here. Structure. Structure is so important. How you sell is just as important as how much you sell. Again, we talked about the 1041. This is a live example. It's a person doing fix and flips. They're in South Carolina and Georgia. They're in the South here. They love flipping properties. This is a Schedule D. So if you do investments, if you have investments, you understand how taxes work with schedules. Taxes, the 1041 return pretty much has the same schedules that a 1040, a personal return has. So these are the different incomes that he had is from these gains. You can see it's $547,000 in gains. He reported everything on the 1040, right? And as you can see right there, no tax. He had some other income too, some interest income. I think he had CDs or whatever, but no tax. Why? Because he had the right structure. So it doesn't matter what you invest in, real estate, stocks, crypto, whatever. If you're investing in a place where you're just deferring the tax, 401ks, IRAs, again, not Roths. Roths are good. There's some other things about Roths people don't realize. We talked about the Medicaid spend down, but it's using the tax code to your advantage. Strategy, keeping more of your money. This is a case we had in California a few years ago. I love talking about this case. I actually worked with a real estate broker on this case to help their client. But as you can see right here on the left-hand side, there's a property in California. This happens all the time in California because properties just have appreciated like quadrillion times. But property was bought in 82 for $217,000. Went on the market. This was, I think, 2024 for about 30 million, as you can see right there. So this was a case where this is a deal that was not going to close because essentially, and they had gone to their tax advisor who worked for KPMG, who was super smart, and he said that their tax was only going to be about almost 6.5, 7 million. He forgot a few different things. And we had to go back to the client because this was part of our process and show them, hey, after everything, when we add your gain, your adjusted basis, depreciation recapture, net investment income tax, all this stuff, it's actually going to be about $10.6 million. And they're like, there's no way in hell we're going to sell. We're going to lose literally 40% of our profits. Okay. Now, listen, walking away with that amount of money is still good after 217,000, and they put a lot of money in it and they had it for a while, but you're only talking about walking away with about $17 million after taxes. And here's the other thing. What else do you have to pay with real estate? Commissions, fees, all these different things, right? You still have to pay that, and you got to pay Uncle Sam and the state. In California, it's obviously a lot more. So they went from that, looking at that, to being able to walk away with about 27.4, even after the cost of the sale and setting up the tax structure. It made more sense for them to do that. Okay. But it's the strategy that we used and keeping more of your money. Now we don't have to pay 10 million, pay a line share of that. You have more money to spend, to grow, and to pass on to the next generation. And then timing. Timing is super important. We talked about time and being proactive, but the flip side of this, and this is something that I work with a lot of real estate brokers, especially commercial real estate brokers, on this, because the reality is with real estate, where does real estate go? Does it go up like this? No, it's this, it's that, it's this, it's that, ebbs and flows. And there's always a mindset in the seller that, hey, I got to get this much, right? They put enough, they looked at comps, whatever. They got to get this much. And so they're hell bent on that. And there's nothing wrong with that. I'm not here to tell you what your property's gonna should be valued at or shouldn't be. I know what the market's saying, but the reality is you're sitting at this price and you're staying at this price, and it's going to take you a while. Might take you 2 months, might take you 6 months, might take you a year, might take you 3 years. Who knows? And we've seen properties that have been on the market for a very, very long time and haven't moved any, and you can't get that time back. You can make more money, but you can't make more time. I don't know anyone that's good enough. Jeff Bezos hasn't done it yet. Mark Cuban hasn't done it yet. Elon Musk hasn't made time yet. I'm waiting. But no one has been able to manufacture more time. And so the reality is, if you understand how the time value of money and taxes and all this stuff, let's actually get a lower price so you can sell right away. Because if we can sell right away, not have to wait a year, 2 years, 3 years, but we're taking taxes off the table, over time, you'll actually make a ton more money. And this is an
More.
example right here where,
Yeah.
hey, we got a $10 million property, right? If we wait a year to sell and we pay the tax, right? Assuming again 24% tax, just about, you're gonna have $7.6 million left over. But what if we could drop it down to eight and sell it right away? We know there's buyers that'll get it at eight, but we're not paying taxes. Now, if we look at that difference, it's only $400,000 difference, 7.6 and 8. But because I had a year, because I had that time that I can never get back, if I'm earning after the sale, and obviously you want to do this tax efficiently, we're not even going to that. But if I'm earning 6%, if we put everything together in parity, you're never going to catch up to me. I'm always going to have more money than you because I had that time. So timing is so important, not only just for setting this stuff up, but learning and understanding how to act. Because every dollar you pay in taxes, it's a dollar you lose forever. You never get that back from a time standpoint. So to wrap up a few different things, at the end of the day, again, we talked about the five pillars: leverage, liquidity, strategy, structure, timing. That's super important. But we got to look at the two angles between the preparation and the planning. Because again, this is about planning. We want to work with your CPA. If you're going to start implementing these things, we need to have conversations with your CPA, with your advisors to start putting this stuff together right now so that by the time you file, we've done everything right and you're not worrying about anything. Otherwise, if you're just focusing on the prep side, you're never going to get where you need to go because most CPAs are just focused on doing the tax returns, not planning. So both of them are important. Not one is better than the other. And again, if you're selling in the next 12 months or less, time matters. The longer you wait, fewer options you have, and you don't want, hey, and what happens if you get an offer, next week or next month, right? So if you don't plan right, Uncle Sam is always going to be your silent partner. We don't want that to be the case. And again, the reason why wealthy people don't care about tax rates is because they plan ahead. They understand how to use this no matter who's in office, no matter what legislations are happening or anything. So, how do you choose a strategy? Well, lots of different things to consider when it comes to figuring out what strategy is going to work because not everybody's situation is the same, number one. Number two, there may be an opportunity for you to use more than one strategy. In fact, a lot of our clients, they utilize more than one strategy. They're not just using the philanthropic LLC or the trust. And by the way, there's more strategies than what we went over tonight. There's a lot more. I don't have time to go into that. But you want to combine and use the benefits with one because they all have their pros and cons to cancel out the weaknesses of the other. Okay. And that's really what's going to help you. But at the end of the day, number one, you have to look at what are you selling? Is it real estate? Is it equipment? Is it livestock? We have some people that they flip horses. I never remember when we went to Keeneland in
Lexington,
Kentucky.
Kentucky.
Yeah.
Yeah.
That
Lexington.
it
That was
blew
fun.
my
Fun
mind how
trip.
much money that you can make in the horse
Went to
business.
the horse auction.
It's
Yeah.
crazy. But we have people that flip horses, so crypto, stocks, business partnerships. So what are you selling? Because that's going to determine what strategies. Some strategies may work better depending on the type of asset that you're selling, even though you can use them in many different ways. there's some strategies that may work better depending on what you're selling, the time frame. Hey, we already have a letter of intent. We're ready to go. Okay, you can't use this, but you can use this, right? So looking at all these different things. Why are you selling? Is it to diversify your portfolio, right? Are you trying to get rid of tenants, toilets, and trash? Are you in your retirement years? Is it, hey, I just want to start aggressively investing, but I want to do it more tax efficiently? Maybe a lot of people are forced to sell. We're in we have a few clients, a few things now. They're going to be selling. They inherited this. They don't need the money. They're going to have a capital gain. A lot of the stuff that we talked about before with the estate planning and co-ownership, they have issues. So we got to help them out with that. Um, a lot of people, hey, we get the calls all the time. We're getting sued, right? How many calls do we get like that, Shelly, every week?
Yeah,
We're getting
yeah,
sued.
that's sad. That's sad when that happens and we're not able to help him because it's not in time. But if the judgment has not been made, there's hope.
Yes. Yes.
So,
There's lots of nuances. We can talk to
we
legal
have a
about
lot of
that.
people here too in North Carolina. There's a lot of development around the RDU area. So there's a lot of lands going for sale and old farms and things of that nature for some more development coming in. So they're facing really big capital gains. So those
Yeah.
structures are very important. If you're in one of those areas where, you own a lot of land or, there's a lot of development coming in, um, you want to have these structures set up.
Yeah. And then the last thing is, what are you looking for? Are you looking for investment? Are you looking for income? We talked about the estate expenses with the kids and the mortgages. A lot of people that's important for them, especially you got young kids. So there's so many different things, and these are things that you got to ask yourself before you say, "Hey, I'm doing this, I'm doing that. I watched some YouTube video, watch this." No, you have to understand because it's not a one size fits all thing. Everyone's situation is different. So, with that being said, if you guys, and we talked about this in the beginning about the capital gains strategy audits, you want to talk a little bit more in detail about what you got going on right now. You're looking at an exit, you're trying to figure out what are your options and what you want to do. Then the next best thing is to set up a capital gains strategy audit. It's a quick 15-minute down and dirty discussion. We just want to understand from a high level. We don't need tax returns. We don't need a whole bunch of documents. Don't need to review anything. Just understanding where you are, what is the game looking like, what's the time frame, what are your goals to kind of get an idea of okay, what could possibly work for you. Um, Once we understand that, then we can move on to the next step and say, okay, does it make sense to get a proposal together, get some documents, start putting an actual plan together to figure out how we're going to set everything up right away? And we move really quickly because, again, we have lots of people calling us all the time, trying to set up stuff. Hey, I'm selling in the next, month, this or that. Grandma, grandpa just died, whatever. So we can move very, very quickly to get this set up, which is why we have only a limited amount of spots and times to take these calls. So if you want to do that, text the word cap gain. If you're looking right here at the bottom right hand side of your screen, cap gain to my cell number 919-420-3798. I'm going to leave that on the screen. And when you text that to that number, you will get a link to my calendar to set up your capital gain strategy audit. Now, this is one of the things I want to caution people about this is that it's just like a very quick surface level meeting. Don't expect this to be 2, 3 hours where we're going over everything. We just want to understand down and dirty. So please come prepared. Basic stuff. What's your basis? Ballpark depreciation. What are you looking at? Selling this for? Is it a stock portfolio? Is it a business? Is it both? Do you have partners? All these things we want to understand so we can figure out, okay, what might make sense. And then from
Yeah.
that point, it's just a simple business decision. We'll tell you, okay, this is what you're looking at. This is what it will cost to start the process to look at and then close right away. Get your CPAs involved. Lots of other things that have to be done because, again, we have to work with your team, with your CPAs, with your wealth advisors. A lot of people have brokers that they're using for their business or real estate. We want to coordinate everything so that no one's doesn't know anything, so that
Mhm.
closing goes smoothly. Because at the end of the day, none of this matters until you actually close, until you actually have the money in your hand, and we want to make that happen as efficiently as possible. So that being said, again, hope you guys enjoyed. Hope you got a lot out of the class. I'll be sending the guide out to everyone that registered, put their email in. We'll make sure you get that. But right now we're going to open it for Q&A. So I'm going to stop my share and we will ask everyone to unmute, and you can fire away, ask your questions, and take it from there.
Anybody still with us?
Everyone's, yeah, we got people here. It's just this is the Q&A time, so
Yep. This is the time to ask your question. So Jim is unmuted. Rob just was able to unmute.
Yeah, I have a question around a particular circumstance where I was in a private placement. I put a nominal amount down with the possibility of huge returns. We're not quite in a letter of intent, but uh, we're in a close situation, and I'm looking to gain probably well, I started out with it was $100,000 PPM, and it looks like I'm going to net out about 13 to 40 million,
okay,
and it is a pure capital gains transaction that will be paid to me. And I just basically, on a whim, wrote a check through uh, through an LLC, one of my LLCs that I had. I don't believe it to be structured appropriate. I do have time. I heard you say time is of the essence. I mean,
yeah,
time is of the essence, but I do think I have some time to structure something, and I don't know if I can backdate or if I can pick up where everything was left off to manage whatever capital gains I may incur. And I want to use that money to leverage, to your point, other opportunities for my children, more specifically.
gotcha. Is it a single member or
It's
multiple
me, a
member?
single member.
Just you.
Well, actually, no, that's not true. I initially got into it with another individual. We created an LLC, and then I went over and above and bought another private placement. So
Gotcha.
really, I have two
Okay, two.
LLCs. One is a was a partnership, and the other one is just with myself as an
Gotcha.
LLC.
Gotcha. Yeah, there could be, and we run into that stuff a lot with PPMs. A lot of private stuff. We deal with a lot of private equity things. So there could be. I don't want to say for sure, but yes, let's definitely have a conversation. Go a little bit more in detail. I don't know if you want to air your dirty laundry in a Zoom call, and kind of take it from there and see what works. As far as backdating and all that stuff, I leave that to the attorneys, and they can kind of guide you and figure out what'll work. But as long as we have time, we have bandwidth. When's the close expected, more or less?
A year to year and a half.
Okay, perfect, perfect, right on time.
I would schedule a call, Rob.
Yeah,
Understood.
yeah, and I'll put that back in the cap gain. Make sure, and then number 919-420-3798.
Does
So,
anybody else have a question?
all right. Well, hopefully you guys got a lot out of the session. Again, I will make sure that everyone gets the guidebook. And if you, again, want to schedule your capital gains strategy audit, go ahead and do that. I think I might have some slots for maybe tomorrow or Friday next week. I'm super booked and be going out of town for most of the part of the week. But again, it's never too early. You want to get this stuff set up as soon as possible, because it's life changing and it's so simple. It doesn't have to be complex, you can just be so much more efficient. That's what we love doing, and we love showing people how to do. So thank you guys for staying on, and you guys have a great rest of your evening. Bye.
Good night.